Good afternoon. At this time, we'd like to convene the Finance Committee meeting of the City Council of Palo Alto for Tuesday, May 20th, 2025. Would the clerk please call the roll?
Councilmember Rectal,
Here.
Councilmember Lithcott-Haynes,
Here.
and Chair Burt.
Here. Okay, before proceeding on to our focus, which is on the budget wrap-up, we have an opportunity for members of the public to speak on any item that's not on the agenda, but is within the purview of this committee. Do we have any speakers?
No public comments.
All right, so we'll move right into the FY26 budget wrap-up and recommended FY26 budget, including the municipal fee schedule. Lauren, did you want to kick it off?
Yes, thank you. Lauren Lai, Chief Financial Officer for the city. And beside me is Paul Harper, Budget Manager. So thank you very much, Chair and committee members, for the work we've done together so far. This afternoon, we have a process to deliberate what we've received and decided on, and then also move this towards budget adoption on June 16th. Next slide, please. One more. Thank you. So to kind of orient us in terms of budget conversations and calendar, we transmitted on the 5th of May. We had 2 workshop days here in this room amongst Finance Committee and all the departments. And then we brought this back to recaucus with the council on May 12th last week. So today we're synthesizing all that new content and then moving this towards budget adoption, where we'll prepare all the technical documents for council to receive, review, and approve on June 16th. Also on that timeline, there is the Nonprofit Partnership Work Plan Phase 1. The PNS, so Policy and Services Committee, will review the applications and make recommendation for award. So here we are on May 20th. Budget deliberation, and then taking the information from council to move towards what we call Finance Committee recommendation. So next slide, please. So this afternoon we have together, we will be receiving and reviewing the council feedback, and then also the additional staff material that we were able to turn around for the committee to review. We'll look at what we call the revised parking lot. We'll look at the multi-year budget balancing strategy. We'll go over what we call technical adjustments, and then consideration for referrals, because in the short amount of time, there is some information that we cannot pull together as of today. And then also a cleanup of what was the follow-up requested by Finance Committee of the April 29th citywide fee study. So we'll go through all that. While it wasn't captured in the memo itself, I want to highlight some of the council feedback from last week. I think what we heard was a consensus around the concerns of the financial conditions and the uncertainty, and then also the support around the retention of the uncertainty reserve. The other aspects that we heard from committee, the council, is just seeking new revenues, and also discussing the gas rate and then the use of the climate credits. And as it relates to services, we did hear discussions about fire and in particular ambulance service enhancements, managing consulting contracts, and then also possibly like a code enforcement placeholder. Also, there was a lot of discussion around nonprofits, mental health, and the JED Foundation. So we'll have an opportunity this afternoon to unpack and highlight a few of those areas that were discussed more extensively by council last Tuesday. Next slide, please. So within the parking lot, we categorized a couple of them into these categories: policies and priorities and vision. These are items that relate to city policy priorities or support the vision. Grants are kind of self-explanatory. They relate to grants to other organizations. Placeholder is a new one. This relates to the goal of retaining at least $6 million of our uncertainty reserve. So these placeholder are budget target values, and we'll bring back the detail in August. Information requested and referral. So some of this material we can provide today. Some of it we're going to propose as a referral that we'll bring back very timely to the committee. All right, next slide, please. So the parking lot, which is at this point, some proposals Finance Committee has moving towards actual recommendation for budget adjustment. Table 1 summarizes the expenditure changes, and then Table 2 will be the revenue changes. What you see before you is $5.1 million of savings or reduced expenses. We'll start at the top. Fire single role ambulance model, that's the 12-hour medic unit that would, and again, we have 2 columns. One is fiscal 26 and fiscal 27. Implementation in 26 with a full year in 27. Nonprofit work plan, increasing the appropriation up to $346,000. CSD events grant program, increasing that from 0 to 50,000 in the proposed budget. And then also youth community services, YCI 50,000. There was a lot of council discussion around having some of these applications go through the review that's being considered by PNS in June. Also, the next 3 lines relates to the direction to retain a minimum of $6 million in uncertainty reserve. We were asked to evaluate alternatives in achieving that, specifically a balance of one-time and ongoing, a 4 and 2 split, plus a balance of CIP and operating savings. So what you have before you is about $1.3 million of new revenue as a part of the solution. So let me explain to you how we get there. 1 million will be from Measure B. We are going to shift the allocation of the local streets funding from Measure B to the street maintenance. That will reduce the CIP transfer from the general fund. Now, that will have impacts down the road at some point as we want to fund bike ped plan.
Yeah, can I,
Mhm.
that was one that came kind of out of the blue to me, was not a referral by the committee or the council. So I don't know how it suddenly showed up.
I thought you meant just the impact on bike ped.
Well, that's part of it.
Yeah.
Yeah.
I mean, I feel like we did talk about, could we use Measure B, local? We were told we couldn't because we had to put in our own dollars in order to like.
It's on grade separation. So
Right. So this,
specifically,
you're right.
yeah.
Yeah. This was not something we discussed before.
Right. So there are, do you want me to go into it now or kind of go through it and then kind of follow back?
Well, we can loop back, but
Okay.
I just wanted to flag that was one that seemed to come out of nowhere, not having been a referral from Finance Committee nor the council.
Yeah. Well, I think the referral from Finance Committee was for us to look at alternatives to general fund, to fund projects that were previously general fund, and then study kind of the impact. So let's go through this, heard the concern. I'll walk us through the fund balance and then also kind of the 3-year proposal here, because it's not indefinite. So let's circle back to that. Then what that leaves is deprioritizing capital projects to smooth out the cash flow. Of course, looking at that prioritization and that hierarchy of how we deprioritize projects. So our placeholder there is $2.2 million with the balance of $2.7 million coming from general fund savings. That sums up to $5.1 million of savings within the general fund. Okay. And then 2027 is a carry forward of that $2 million. So going to the next page. All right. So on the revenue side, sources that we've identified and shared with you before was the April 29th Finance Committee update on the transport fees for fire. That's the ALS, BLS updated fees. So that's about $700,000. In addition, you may recall that in that same study, there was the recommendation, which Finance Committee also approved, of the new first responder fee. We will be one of many other agencies that have implemented this. The study did show that it could generate about $400,000. This would be billed in combination with the ALS BLS, and it will be a new fee. And because it's a new fee, we're only recommending 100,000 of the 400,000 to acknowledge the implementation and all that. And so we're putting it there as $100,000, and then you'll see in year 2 it's 200,000. So, but the study does show almost $400,000 from that new revenue. So we're just putting a pin in that, and staff will move towards implementing it should council on June 16th approve all the recommended fee increases. CSD, so staff looked at charges for service and feel that we have capacity to increase our revenue assumption by $100,000 on top of what's already in the proposed budget. This would relate to a focus on rental and reservation fee revenues. And so that brings us to a total of about $900,000 of increased revenues here. And then higher in year 2, because we'll have a higher estimate for the first responder, and then also the $4 million of saved uncertainty reserve. So that's how we roll forward fiscal 26 and fiscal 27, with an anticipated potential savings of $6 million in the 26 fiscal year and reducing the 27 shortfall by $5.6 million. Okay. This will achieve retaining $6 million in uncertainty reserve. Next slide, please. All right, now how we read this is the roll forward of our general fund multi-year balancing, and then also the financial position on the uncertainty reserve, and then also our BSR. So how we read this is the first column is the proposed budget as published in these books before you. The second column is the revised 26, should we incorporate everything that's in the parking lot that I just went over, and then the net change. So you'll see there that 26 is balanced with $6 million of uncertainty reserve. And then the uncertainty reserve at the end of the year is $6 million, and budget stabilization ticks upward to 17.6%. Moving to the final column, because the direction is also to carry forward the uncertainty reserve, but retain $2 million for 28, and then also carry forward and continue at least $2 million of ongoing savings. You'll see the revised shortfall in 27 is now $4 million. And then also we have $2 million of retained uncertainty reserve for future contingency. The BSR is a percentage of operating reserve, so that does drop. So we still have some work ahead of us to shore that up, but that kind of shows kind of how the multi-year kind of evolves with us continuing to dial back on the appropriation and then also retaining the uncertainty reserve for future offsets in 27, 28. Okay. As noted in the footnote there, we do anticipate fiscal 25, which is the current fiscal year, to have a fund balance. That carry forward is not represented above. And so soon you will be receiving the Q3 report in June. And so we are analyzing both the revenue and the expenditure side. But we're hoping that our continued diligence in the current year will provide carry forward balance as another measure to tactically kind of deal with the uncertainty that we have at hand. Okay, next slide, please. Moving into the specific topics on the parking lot. So the nonprofit partnership work plan phase 1 and the recommended adjustments. This slide was presented last week to council. The update is just representing that at council discussion, there was discussion about having the direct allocation also be incorporated through the application review process underway with PNS. Also, as we further studied the application, it turns out that one of the application did make it by the deadline. So 20 of them were received by the deadline, totaling 797,000. And then of that, if we pull out the nonprofits listed in the table above, we have 401,000 remaining, all of which, all 20 applications will be provided on May 28th for P&S to receive, and then also in June to make recommendations of award that will come back to council as a part of the June 16th budget deliberation. Next slide, please. Items that are not on what we call table 1 or 2, which are revenue and expenses that were discussed by Finance Committee related to debt issuance and potential refinancing, historical positions filled and vacant, a summary of mental health investments and appropriation. Also, this committee in April wanted to create a new category for 100% cost recovery in our fee policy or cost recovery policy. Also, the gas utility rate and technical adjustments of various funds. And last but not least, our technical adjustments and then the municipal fee update. So I'll summarize those and then certainly open for more detailed questions. Next slide, please. So while in the memo, which we did publish last week, we weren't able to put this table together, but by this morning and more importantly last night, staff was able to put this table together of highlighting in the budget the mental health direct funding. Again, this is just the direct funding. We contribute even more than this in terms of mental health, especially when we look at the level of real estate sometimes that we have heavily subsidized for various nonprofits that partake, that contribute and partner with the city. But when we look at just mental health direct funding, the table above summarizes that in fiscal 25, we have about $600,000 in both 25 and 26. And this includes direct funding without his rep and direct funding with his rep. And so those are some notable partnerships and direct funding contracts. In addition, we have programming and special events within CSD and then also within the library department that support community mental health, not just what's enumerated in the table. Also, there was discussion about the JED Foundation. Staff is working with the foundation, and should there be a need to, as we move forward and looking at funding, we do have funding capacity within CSD and also within CMO within the proposed budget. We have non-designated contracts appropriation within CSD, and then also within CMO, we also have contingency reserve. So wanted to highlight that because it had come up several times in council deliberation. And then as noted there, other his rep grantees and city efforts do provide indirect support to mental health as well. Next slide, please. Moving on to debt financing and refinancing, we did reach out to our fiscal advisor, PFM, wanted to kind of go through some best practices and also determine if we have an opportunity to refinance any outstanding debt. So just, I think, some thumbnail facts and points of reference. The city has one of the highest credit ratings at AAA for our utility. And then also Moody's affirmed our city's AAA credit rating as well. So that's exceptional. When we look at best practices for debt financing, we look at a couple of key points of measure. One is credit rating, tax and ratepayer impact, and then also capacity to pay, and then capacity relative to cash flow. So talking about credit rating, it's exceptional. But what could move credit rating also is if we move too far on the spectrum where we become higher risk, then these rating agencies may downgrade us. So a couple of the categories that they bring to our attention is, what is our debt ratio as it relates to general government debt? We are right now in the modest category as it relates to general government debt. As it relates to enterprise debt, they do have a ratio of net operating income over debt service. The minimum is 1.25% ratio. We do exceed that. And also kind of as a benchmark and a measure, we look at our debt service as a percentage of citywide expense. So that matrix right there, that table right there shows when we look at the 2023 State Controller's Report, we have 1.7% debt service as a percentage of our citywide expense. Other cities within Santa Clara County are at 1.9, and all cities within the state of California are about 2.6. So that relates to the credit rating portion of this best practice. When we look at kind of budget, cash flow, and cost of issuance, a rule of thumb is a 15-to-1 ratio. And what we mean by that is if we have $15 million of principal that we want to borrow, the debt service every year that we have to pay is about $1 million. So we could borrow $15 million and it'll cost us about $1 million over a 30-year period. With that said, I mean, that sounds great, right? Because that sounds like we can finance a lot, because $1 million is a lot less heavier of a cash flow lift than 15 million. Then we look at cost of issuance. So one aspect of cost of issuance is what is the soft cost for underwriting, FA, legal. That's about $500,000 out the door. And so we want to make sure we look at that relative to if we're going to borrow 5 million, 6 million, does that really make sense? So those are immediate sunk costs. However, the larger cost is really that cost of interest over the life of the debt. So in the memo, if we borrow 15 million at 5% over 30 years, the debt and the interest is about 14 million over 15 million. So it creates opportunity, but also in return, we are paying for that in financing cost.
So just to clarify one statement, you said the cost of issuance was about $500,000, but I thought I read in the staff report that the fixed cost was 300,000. And so it was $500,000 for a 15 million, but
Correct.
not, as you said, $500,000 if we did 5 or 6 million.
Yeah, so let's unpack that more specifically. We have in the issuance cost, there's a fixed cost, which is usually the FA and and so that's about 300,000 in today's market. There's another portion, underwriting and otherwise, that is a ratio of the principal borrowed. So that portion does grow. So if we just kind of assume a $15 million debt in this example, that issuance cost is $500,000. I think the point is, if we desire to issue debt, we want to make sure it's financing long-term assets, but we also want to look at the cost of issuance and make sure that, there's a bang for the bucks. So, yeah. Stepping back is, issuing new debt to finance long-term asset is really important. Typically, it's not issuing debt to finance pay-go things or something that may have a very short useful life, because debts usually run 30 years. So we want to make sure that the asset pairs with that debt service period. So that's new debt. Then there's the opportunity around refinancing existing debt. The city does have a debt policy as required by state law. And the debt policy governs when we issue new debt, what kind of debt we would issue, and when we would actually refinance our debt. So our policy in simplest terms sets that we need to have at least a 3% net present value savings. So if based on the debt outstanding interest rate and what we can refinance it at, when we do the net present value, we have to save at least 3%. And so based on current studies, we're on the margin of that. Nothing really jumps out at us. And so we will be looking at it again on a regular cadence quarterly. There is one, which is what we consider the water bond. That is kind of complicated because we do have state credits. We would have to assume right now that if the state credit goes away altogether, we could have substantial net present value savings. Nothing today that staff is aware of would lead us to believe that those state credits would evaporate. If those state credits stay in place, the net present value is on the margin of this 3% right now. So it doesn't prompt us to really institute or suggest debt refinancing. With that said, we are instituting quarterly meetings with our FA to make sure that we seize opportunities, especially in this volatile market, and then bring that back to Finance Committee on when the opportunity presents itself.
Did we do any refinancing in the last few years?
Do you have information on that?
Because the interest rates were just historic lows. I would think at that point you would have been easy to get the threshold.
Paul Harper with the Office of Management and Budget. Off the top of my head, I recall that we did refinance, I believe, a parking garage loan that we had from the early 2000s. I can look in the budget under the debt section to get more information, but that's the one that comes to mind. I believe we did something with the golf course, and Taryn is there with probably more information.
Excuse me, if I may, Taryn Narayan, Manager of Treasury Debt and Investments. The last one we did was the general obligation bond. That was in the 2022 timeframe. So that was the most recent refinance we did. The others, we hit the market at good times. So the rates were relatively low. As Lauren mentioned, there's no really present savings at the current interest rates unless the interest rate substantially declines.
Yeah, I would like to give credit to staff. This is an activity on an ongoing basis that staff is keeping an eye out for, such as was the case when previously refinanced. So, as was mentioned, these debt instruments are typically 30-year debt instruments. So we can see when the rate environment is becoming favorable, and also based on just the aging of the debt we have outstanding, that staff does on an ongoing basis take a look at this. And so based on this conversation, staff has noted that instituting a quarterly look at this would set more kind of a routine to that on an ongoing basis.
If we've been looking at this, I suspect that our rates are pretty low right now.
We are, yes, we're in an enviable position, especially the other recent one was at the time of the public safety bond financing, where certificates of participation were used. I believe we were quite happy with the rates that were existent at the time.
And our three biggest ones were the public safety, the Calab garage, and then back in 2009 or whatever, the libraries, and they were all at times with exceptionally low interest rates. We also have the golf course and some others. But
And what are the biggest ones we've done of those? No, but what is the amount that was?
Darren, do you want to do this, or
If I may,
go
the
ahead?
biggest one was the public safety building, around 100 million or so. Then more than a decade ago, the library geo bond was probably the next biggest one that we did. And just to put a point on it, the police building true interest costs were 2.13%. So that's pretty low.
The interest costs were 2.13. Okay. And you said it's a 15-to-1 ratio. So if the building was 100 million, the debt service annually was about.
No, that's where we would be based on current interest. It was lower,
Right.
based on the lower rate
Got it.
interest.
I'm actually just forward thinking to a future thing we might want to fund with debt, hypothetically. And curious as to where the money for the debt service comes from. Is there a budget? Is there a reserve? Is there a debt
Well,
service? When we think
so
we
it-
might want to fund something that's going to be debt at 100 million, it's going to cost us 6 million a year. We have to find those funds all at once, or we
Right.
have some kind of ongoing, we might need to
Such as
service.
a parcel tax or a other form of revenue. Yes.
But for example, the public safety building and the Calab garage, those are just out of general fund. And so we didn't have $150 million in cash.
Right.
So we debt serviced it and then we have to pay the debt.
So
If I may add context, if you issue certificate of participation, you have to come up with money that you have existingly. If you do general obligation bond, that's usually a partial tax. If you use utility revenue bond, obviously that comes from the utility rate payers on the ongoing basis.
Just asking, we have so many different reserves, which are all incredibly impressive and useful. And I just wondered, is there any sort of reserve that I haven't yet read about that anticipates we might be issuing debt and we might need a little bit of runway to start doing the debt service? So that was where my question was coming from.
Excellent question, because I think that speaks to the budget cash flow component. So anytime we look at debt, we're going to need to look at that debt service annually over 30 years and then identify the source. So reserves may help us towards something like it may require a reserve for the debt itself, similar to our public safety building. We have to set up a reserve because it was a COP. But I think more importantly to your point is that 15-to-1 ratio, that 1 million. We need to come up with that 1 million for 30 years. So yes, and depending on the nature of the debt, if it's a GO bond, it would be against property owners. But if it's a COP or otherwise, it would usually be within existing revenues or other creative financing, such as our TOTs previously enhancing revenue to create that capacity. Okay to move on, or?
can I just clarify one thing? The debt service for the public safety building and the CalAV was built into the TOT funds that we transfer from the general fund. And so that is a portion that covers the debt service there, is the TOT funding coming from general fund.
Yes, so
So
that's the
for-
creative financing where we enhanced revenue to create that flexibility and revenue stream, which enabled us to back up and support that debt service.
I was just going to point out that ultimately, though, the general fund is the backstop on that. The hotel tax funds provide the cash flow, but ultimately, general fund is the security.
There's a state fund that we borrow from sometimes. That's just short term?
The
It's
state,
state revolving loan fund specific to wastewater treatment is a program that we've used several times over the last few years.
Constrained though to wastewater.
Yes, in that
Okay.
particular program.
and it's excellent in terms of the borrowing rate. So we definitely maximize as much as we can in the SRFs.
Okay, but there's nothing
To
for,
answer your question, it's for the long term, 25, 30 years, etc.
oh, it is, okay. But there are no other state that we could use for general obligation for, general fund? If we had to borrow money for the general fund, we don't have any state sources to do that?
Not that come to mind.
Senator Cortese has just introduced legislation to create such a fund for affordable housing. But
Oh.
otherwise, I'm not aware of any other.
That would be very nice.
Okay to move on? Okay, next slide, please. Wanted to recap where we are with different types of utilities. So based on the different deliberations we've had, what's before you is a table that summarizes the fiscal 26 proposed rates not really rates, but the percentage impact on median residential utility bills. And so you'll see there as asterisk, it's the gas utility one that I think has been moving a bit in the last couple of months before UAC, Finance Committee, and Council. This does reflect the most recent deliberations at Council, wherein we are using the cap and trade funds to reduce the G2 small and medium-sized customers. The amount of credit used will range between 1.1 to 2.2 million, depending on how quickly we can implement the new rates. And that shows also the impact estimate for a medium residential utility bill of about $32.70 in 26.
And can I ask, the gas 5% for 2026, is that the same percentage increase that we had previously been looking at, or is that revised? I had in the back of my head it was higher previously, but maybe I'm just forgetting.
Which previously, because one was, if Kylie, you want to speak to that? Because we've had multiple numbers, or we had one in the proposed budget, and then it evolved from there because we had a prior proposal to this climate credit. And now this is where we are, because I think it went from previously was about 13, right, Kylie, on this chart?
That's
So
correct.
previously this was 13, Chair, and then it's dropped down to 5.
Okay, and that drop, is that because of the climate credit or other changes?
I think it's otherwise. Kylie, you want to?
Yeah, it's otherwise because this is specifically the residential utility bill. And so this reflects the switch from using the 2025 cost of service analysis with a climate credit. That was what the 13% was. And this is switching it to using the current rates growing for the cost of the additional cost to do business while we continue to finalize the 2025 cost of service analysis.
Okay, so this is based upon continuing for the time being the use of the prior cost of service model? That's
The
what,
2020, yeah, it's using the 2020, it's using basically, yes, the current rates and the
Got it.
current rate schedule and escalating all of those rates by about 9%. And so because that's only a portion of the rate, the bill translates into about a 5% bill increase.
thank you.
Here I am. I'm talking the whole time. Thank you. So we're updating Finance Committee on the April 29th cost of service study related to the departments listed above. The revised report is listed online, posted online. In addition, I'll walk us through briefly the items that Finance Committee wanted us to clarify and verify. The domestic partner registration fee, we felt that we should retain that as a city service, as a customer service for those who wish to register here. However, we will align our fees with the state, which is $33 instead of what was previously proposed. ASD fees, we had a couple that needed adjustments for the fee policy, so we updated the fee policy to align with the fee recommendation. Those pertain to mailing and duplicate receipts. Also, the committee wanted us to put any real estate conveyance transaction at full cost recovery. So that's also reflected as well. So no subsidies there for any real estate conveyance transaction. Police special events, as noted, I think some of these fee titles were carried forward from many years ago, and with the careful review by committee, it was identified that in the police special events, some of the fee titles didn't seem to overlap properly. So we've recommended cleaning those up. So they are really now special events for nonprofits, or special events with co-sponsorship by the city. So we removed the percentages, which didn't seem to align correctly. Animal control, there was some dismay about, I think, city costs related to impoundments that exceeded 5 or more transactions. We reviewed our ability to increase those, analyzing whether or not there are really fees or penalties. We have determined that for those transactions exceeding 5 or more incidences, we will be able to charge more than the cost here, because overall, categorically, it's not full cost recovery. So those are reflected to hopefully account for that type of impact upon our city staff, and then also recover the cost accordingly. Flood zone determination letter. I think Finance Committee was curious why it seemed like we were making a copy of something cost so much. When we studied this with Public Works staff, it turns out lots of times these require discussions with staff. They want to meet with staff. They want to discuss the FEMA zone. They want us to write a letter, talk with their oftentimes real estate client. And so the flood zone determination fee was actually an estimate of staff time incurred. It was more than just simply making a copy of here's your flood zone. And so that's what we determined once we circled back with staff. Taxi fees, as shared with committee, it's been a long time, maybe 10 or more years since we've done a new application fee for taxis. As we're all familiar, most of us use Uber or Lyft. And so staff determined that we could reduce the time estimate for the application down to 20 hours instead of 30. Odds are we're going to have very few of these in the foreseeable future. That does reduce the estimated cost, and so that's reflected. Last but not least was the committee wanting a 100% category. That is updating a policy, so we do recommend that that become a referral, and we could bring back the policy to this committee and add that or anything else you may want to revise in the cost recovery. Okay, I didn't want to put the detail into the slide, but wanted to walk staff committee through it. So if you're okay, that'll all move forward to council on June 16th as a part of budget adoption.
So if we wanted to include that 100% category, does that have to be done on the yearly, or can we do it in the middle of the year and just have council vote on it and instantly change the rates?
No, we wouldn't change. Let me make sure I understand the question. Does the question pertain to updating the policy or updating the fee?
Updating the fee.
Okay. We do the fee updates on a more granular basis, such as PDS coming separately. I came before this committee on April 29th, and then on May 7th, we came back with all the fees that weren't captured there. So we do the fee update on a more granular basis based on the level of cost recovery. Not everything is at 100%. Then there's the policy, which we heard from committee that we should have a policy that just clearly says 100%. There's no band here. It's not 70 to 100%. It's just 100%. That policy can come back to this committee at any time in the near future. This committee can update that policy, and then it'll go to council for full adoption.
And then when would those fees actually be started charging?
So the fees that you have all been deliberating on will be effective July 1 for those that are property related. The ones that are property related takes about 60 days. So that's usually about like August. So it's very important for us to do this in a timely manner in conjunction with budget development. So these will all come to council on June 16th, and then most of them will be effective July 1.
And if we introduce this new category, which is 100% recovery, some of those currently are not 100% recovery.
Correct.
And so we change that. Would those fees change instantly, or would we have to wait till next year to update those fees?
Okay, so generally we do this on an annual basis because it's been such an exercise that we want to consolidate all the user fees and the members of the public understand where our fees stand. It sounds like we want to do another deep dive into the fees to see which categories that we may want to set at 100%. So I think what I would suggest is when staff brings back the fee policy, we can discern from Finance Committee which categories we would want to put into the 100% category. Look at that in comparison to our user fee schedule, which has like over 1,000 fees almost, and then discern if there's going to be a material impact on that new classification. If it will be material, then we could make a mid-year adjustment. If it's not material, then we probably recommend bring it back at the next budget cycle. Does that sound reasonable?
Material in terms of staff time or dollars of revenue that will accrue to us by making these changes?
Probably the latter. Probably the latter is to figure out the fiscal impact to see, if we put more categories into this bucket, can we approximate the fiscal impact? And if the fiscal impact is significant, then it's worthy of the staff undertaking.
Well, the third consideration is impact on the fee payer.
Correct.
Yeah,
Mhm.
so
Yeah.
I just want to make
Yep.
sure we're laying that out.
Yep.
Yeah.
Mhm.
And so it sounds like there's really three steps. One, adopting a policy that we want to have such a category. And the second is to look what would be the groupings that would fall under that category. And then the third would be to implement that. I just want to make sure that there seemed to be consensus that we were interested in such a category. So I don't want to wait to establish that at the policy level. That doesn't mean you're right away going to start implementing it. That'll wait until we come back with those. But I don't want it to come back months later and it be, well, will we or won't we have such a category?
Oh, yeah, no, I believe we all understood clearly that there is going to be a 100% category, which is great because there's more clarity. Currently, the way it reads, it's at 70 to 100%. Right. And so I think establishing the category is one thing, but I think as the committee has deliberated already, we also need to understand from a policy perspective which fee categories fall into this new category. I think what we heard is, in April was real estate conveyance. That's clear cut. We want that at 100%. So good.
But back in April, we weren't answering the question, what items should be in this
Yes.
category, right? So
Yes.
we're going to want some guidance from you, recommendations as to what logically would fit in that category, right? And an estimate of how many revenues, how revenue will increase if we do that.
Yeah. So it sounds like what from here is the referral is more than just updating the policy, but also for a work plan to looking at existing categories and the cost recovery and maybe a recommendation of some movements based on either participation demand and or, what the market would bear. So good feedback, more evolved than what we originally thought, but that's why we have these discussions. Okay, to move on then. All right, next slide, please. We also have a lot of technical adjustments, which are typical in a budget process and an audited financial statement process, so nothing to be unnerved about. This is a common in something that's so technical and voluminous. On May 7th, staff did mention that there were some utility funds misstatements. Those do affect, and we will be amending the 5-year capital. In the memo itself, there is also reiteration of the wastewater collection fund. None of that misstatement affects any of the rate settings at all. So wanted to reassure you. Throughout the year, we also have a reappropriation exercise. Basically, it carry forwards budget appropriation into the new year, and it's an efficient budget process. So we reappropriate those, and we will bring those back during the June council budget for adoption. And then we will provide a lot of this detail that's incorporated into the packet and the agenda for council's receipt and approval. Again, these are usually administrative in nature. Anything that would materially change the outcome, we would have brought to your attention. So in addition, as a part of good governance, we need to make sure that our budgets comport and support other important governing documents, such as the stormwater fees being used for restricted purposes. And then in addition, that our CIP plan aligns with the comprehensive plan. In the packet you have before you, both oversight committees have submitted letters of confirmation for your review. Last but not least, we were not able to provide the data for the historical position filled and vacant going back, I think, 6 years. So we will be bringing that to this committee in August. We hope that the summary about mental health is sufficient. If not, let us know. And then last but not least is cost recovery. We heard more clarification this afternoon, which was very helpful.
On the historic filled in vacants, there was a subgroup that was simply pre-COVID 2019, how many filled, today, how many filled. That should be a real easy number, and maybe we can even get that today, because that just shouldn't be a complicated number.
I
I think it's right in
I
staff
think if-
records.
HR is listening. We are wanting pre-COVID numbers, what was filled and not filled.
Yeah, FY 2019, how many filled positions, how many people work for the city versus how many were authorized, and then today.
Okay.
Yeah.
I think sometimes it has to do with one point in time. So we'll pick a month where the budget FTEs are fully loaded. So let's see if HR.
I'd like to say we've been reporting this on an annual basis for many years. And so I'm hoping that that's a pretty easy request to fulfill.
I don't remember that we report the filled positions versus the authorized, and then the vacancy level. So it's computable, but I don't recall seeing it reported as filled positions. It was inferred.
Aren't those, just so
implied.
I'm clear, authorized equals filled plus vacant?
Oh, yes.
Right. Okay.
Yeah.
Yes. So I think we can,
Yeah.
we should be able to get that. So again, we'll confirm with HR.
And while we've got stormwater here on this final slide, I noted that the 2017 ballot initiative has led to a excess in revenue over expenses of 1.5 million in the current year and 3.6 next year. There was something in the packet to that effect. I'm just curious as to whether that offers any relief to the general fund. Is there, if those dollars can be used to fund capital projects in stormwater, does that free up any general fund dollars, or are the stormwater projects always funded by stormwater funds?
The stormwater projects are funded specifically by the stormwater fee dollars. And yeah, that's a separate fund.
Okay. Finishing slide. So the exercise before us this afternoon. One more slide, thank you. The exercise before us this afternoon is for this committee to formally vote upon moving items from the parking lot to a committee formal recommendation, which we will convey to the council and also modify the proposed budget so that it is ready for council's receipt and approval on June 16th. So next slide, please. This would relate to any recommendations for the operating budget, capital budget, and also the CIP plan and the municipal fees. So we are here to answer any questions. We also have other departments listening in the next several hours. And so if there are certain topics you know you're keen to talk about, let us know.
Shall we hear from members of the public first and then go into questions and comments? All right.
We have 2 public comments online. Give me one moment. Okay, our first public speaker is Hamilton.
Thank you, and I really appreciate your patience listening to me be the squeaking wheel. I urge the committee to not include the 2.2 million in cap and trade funds for a rebate to small business and medium-sized businesses. The COSA was rushed without proper review, and staff should not have expected a rubber stamp when making such drastic changes way outside normal parameters. The 2.2 million rebate pre-assumes the 2025 COSA is correct and rates will be exactly what is already recommended in the new study. This makes it hard for the UAC to revise the 2025 COSA or do a new study. And so it makes it hard for them to come back with a new recommendation. Thus, it actually increases city liability if there are any changes. The rate cut for medium-sized businesses is less than that for small businesses, so should not be paid. Payout to small businesses were not planned until January 2026, so there is time to get better visibility at the UAC at very least. Lastly, I've talked to a lot of residents who strongly oppose repurposing cap and trade funds from their original purpose of permanently reducing greenhouse gas emissions. Besides PAN opposing the use of greenhouse cap and trade funds, I was just talking to a neighbor a few days ago who was absolutely aghast the city was considering this given its goals, priorities, and values. Thank you.
Our next speaker is Adam. Go ahead, Adam.
Hi, yes, I like to talk, so yeah.
Oh. Adam, can you hear us? Go ahead and unmute yourself. Poor guy. Adam,
Adam, if you subsequently are able to hook up, we'll give you another opportunity to speak in a little while. Okay, colleagues, Julie, you want to go first or? Okay.
Yeah. I'll ask a few, maybe more technical questions first. I think we have a more substantive conversation on the nonprofits to be had, but let me just run through some technical things. So on the single role ambulance, we are allocating a $600,000 revenue. Wait a minute. Yeah, right, in fiscal 26, and then it's double that in fiscal 27.
So it is kind of confusing. Let's start with table 2 on slide 6, if I may.
That's not the one I'm talking about.
So slide 5 is the expense side, and then slide
Okay.
6 is the revenue side. Do you want me to start with
Sorry,
that?
what? Yeah, I didn't
Revenue.
think it was revenue.
It's
I
okay.
confused
It's okay.
myself. Let
No.
me rephrase my question.
I get it.
Table 1,
Table one, okay.
single role ambulance.
Mhm.
We're saying it's costing 600,000 in fiscal 26
That's right.
and 1.2 million, double that
Yes.
when fully implemented in 27. My question is, why are we allocating fully half the cost in fiscal 26 when folks will not be hired until April? Right? It won't be operational, we've heard, until April, which is Q3 of the fiscal year, if not the start of Q4. I'm just wondering if that's not too high an expense.
Got Deputy Chief here who could describe that, but I believe it's related to the hiring of the administrative staff earlier. Oh, he nodded. So I guess
Yes, that's correct.
the answer.
The implementation of the single role is two pieces. Like Mr. Shikata said, there's administrative personnel that are going to be hired early on to help set that up and onboard those personnel. And then there's the actual personnel that will staff the ambulance. So you are getting a portion of both of those in the reason for the half cost in fiscal 26.
Thank you. And then turning to the placeholders, we have this massive placeholder of unknown general fund expense savings and fiscal 25 ending balance carryovers, which staff is estimating as potentially being $2.7 million, which is precisely what we need it to be in order to balance, which of course means we're going to go find those dollars. And the carryover we can't find, but we can decide how to allocate it. When I see this, it's such a general statement of words in the context of dollars and cents. It leaves me with this great discomfort of the vague statements, you know, sort of like we might have general fund expense savings, and which is great. And you've said that we will review functions, contracts, general expenses, alternative delivery models. Alternatives may also include additional revenue sources. And those are, again, descriptions of, you know, massive categories of things that might yield the dollars we want, but we won't know for quite some time. In the meantime, in the balance of our meeting, one of the things we're going to be haggling over is tiny amounts of dollars that nonprofits need. And it feels as if we are forced with a time frame to nickel and dime on the nonprofits and put them in the right categories. And is this one going to get 45,000? This one 40,000? This one 100,000? When we have these massive buckets of things that still have to be looked at, where we're going to cull savings out of general fund expenses. And I'm just struggling with, it feels like an apples and oranges situation. It's great that you're predicting 2.7 million in savings from general fund expenses, but it sort of begs the question, like, how, if you can get 2.7, can you get 2.8? Can you get 2.9? That'll allow us to fund 4 more nonprofits, or maybe 8. I'm struggling with this.
So I had, as long as we're on that line item, I had I share your concern there, but I had a much more substantial concern here. When we gave the direction to come up with 6 million in savings from this budget, my understanding was, and we had, I thought, discussions that we also had an unknown amount that would emerge as ending fund balance. But that wasn't part of the 6 million that we asked to be cut. And now the ending fund balance is being implied to be part of that 6 million, isn't it? Okay, so then how do we, well, it says it here. Can you explain that?
Sure.
I'm so sorry to interrupt. Before we continue, do we have time for the public comment too?
Yeah, right after this explanation.
no problem.
Okay. So, I think part of it is because these numbers all kind of look the same. Let's go to slide 7. So I think slide 7 is where we indicate there are anticipated fiscal 25 fund balance that will carry over that's not represented above. So this is the only notation of the fund balance. It's not included in any of the reduced appropriations above, and it's not included to offset any of the shortfalls above. It's just a footnote.
Slide 5.
So then we'll go back to slide 5. Yeah, we'll go back to slide 5.
Page 9 of the staff report that has a whole paragraph on it.
Okay, so let's go to slide 5. So slide 5, fiscal 26 column, this represents the additional costs for services related to fire and nonprofit allocations, some of which were originally omitted. And then the line items related to retaining $6 million of uncertainty reserve. In order to retain 6 million, we have to reduce expenses. That's what those 3 line items are. None of that is assuming that we're taking any of the fiscal 25 carryover. If we do, per the memo, let's clarify what's in the memo. That's only to the extent we can identify contracts, for example, that are closed project that we could relieve some of those expenses.
We're looking at the bottom line, department NOM,
Yes.
general fund expense savings, and fiscal 25 end funding balance,
Yes.
details to be determined, equals 2.7 million.
Yes, I could clarify that further.
That's the part we're
That makes
concerned
listeners- I
that
know.
the end fund balance is definitely a part of the
Yes.
ultimate 6 million we're
Yes.
trying to recoup.
Let me clarify, and I'll clarify that. It is very clearly my expectation as the CFO that fund balance is very judicious. We are trying to identify contracts that we're going to let go and relieve and unencumber funds that we can put into that number. We are not going to take, let's say, any fund balance that we get from fiscal 25 and just sweep it into the 2.7 as an easy exercise. That is not the intent of that clause there. So did that give you clarifications? Because there are some contracts that we have currently where those monies can be unencumbered. That right now is not very much. And so I think in some ways, having that clause there created more consternation than it added value.
I wonder if we're using terminology differently. This ending fund balance is a specific, there may be some balance in some funds that you can carry over. There's a whole separate thing, which is fiscal 25 might have a surplus at the end. And we'd have to figure out what to do with that, carry over, roll over, or put it in different places. These are not the same thing. So any surplus we get out of fiscal 25 at the end, when it's all netted out, that's nowhere in here. That's not, we're not relying on any of that to make the 6 million happen.
A small amount, and that's why I think in some ways this may have caused more consternation. In the Venn diagram, that surplus, this could be a small portion of that surplus, where we could say we've identified certain contracts in the current year that we could close out, disencumber, and then count that towards the 2.7 million. But I think that's caused some consternation here. So it's certainly not the big, any type of surplus or fund balance we anticipate for 25. It would just be very identified transactions. Does that help clarify this a little bit?
It helps, but I don't know that it gets us there.
Okay.
So now as I think this through, we have what would be the expense savings that we would identify out of what was projected for FY26 and things that are yet to be cut. And we're leaving it up to staff to come back with what those are. Combination of positions that we may elect to not fill, consulting contracts, other savings. And then we have what would have been the end of fiscal year 25 fund balance that we typically have a certain amount. And we've heard from staff, they're already working to reduce some of those expenses from consulting contracts, from judicious decisions on which vacancies to fill, et cetera. We heard that. So that may increase the ending fund balance from what we would have had under business as usual. But those are two different things. And I'm not sure where the one you're talking about, Lauren, falls within that. I would be a lot more comfortable if we just identified the FY26 general fund expense savings that are yet to be determined. Then we have another line, which is FY25 end of year fund balance, TBD.
So I'm seeing nodding heads from the committee. I think we here at the table and staff who are listening can also follow along and hear and ascertain the wishes of the committee. So as we move forward before August 19th, we have an exercise to develop a recommendation that supports the 2.7 million. And we did hear that the desire is to find all that in 26 and not dip into 25. If we identify anything, we could bring those back separately for consideration. Is that the consensus here? All right.
I just have a couple more things. Okay.
Should we?
Oh, the public commenter. Yeah.
Adam, go ahead.
So, so what I would like to talk about is like that buildings in the United States needs to be more strong. So that I would say that your buildings in the United States needs to be more secure because of the tsunami happened in just in the United States, needs to be more strong, and it cannot stop like it's damaging the whole property in the United States. So I'm interested to put new buildings. So I want to see if would you able to build your own new buildings in your own places. Like that's what I would say. So that's why I'm here to talk, like, when I'm talking about that.
Okay, thank you.
Okay. My final two questions are, I saw that Matrix Consultants said, and you acknowledged that we're going to earn 400,000 annually from that new first responder fee, but we're budgeting much more conservatively at 100,000 for the first year. Where is your confidence level on that? just given how tight things are, is that something we could push to 200,000 in this first year? Or, do you feel really strongly about 100,000 is the right allocation?
I'm wondering if Fire would like to comment on this. It is a new fee. I believe there are 16 other agencies that have moved forward with this new fee. I think Amber can speak to it. We currently only assume 25% just to give us a certain level of, conservatism in our assumptions. Amber, did you want to add to anything I shared there or?
Sure, yes. Good afternoon. Amber Cameron, Senior Management Analyst with the Fire Department. And yeah, we do believe that we're going to be able to collect the fee, as it is going to be an add-on to the bills that are currently sent to our insurance, or the insurance of our ambulance transport patients. So it's going to be added on to billing that we're already sending out to our patients. The sort of the thinking behind starting off with a smaller amount is to see, how the other increases are tracking. We are also increasing the base fee, and we just want to make sure that we are collecting what we're anticipating. What we were discussing internally was coming back at mid-year and adjusting based on 6 months of actuals coming in from all these fee increases.
Okay, thank you for that. The final thing, we already alluded to it, but I just want to make sure we don't lose it. The notion that if we take $1 million from Measure B, we are harming support for bike ped safety action plan implementation. And I think that came as a surprise to us. So we want to talk about that further.
Sure. So there is a pre-existing fund balance for this as well. And so part of our staff analysis in looking at alternatives to funding capital, I think came from the discussions we've had to identify other sources of revenue. So Measure B, local streets funding does have some flexibility, and it can be used towards street maintenance. As a part of the general fund's base transfer, we have been funding the street pavement and improvement. And so the proposal here is to take 1 million for the next 3 years, which is where the cash flow is stressed. And then that will relieve the general fund. That leaves about, I think, 7 million still remaining for bike ped. And so it's not an ongoing reduction of that resource. So going into it, we have about 7 million. We would then transfer the next 3 years, and then it'll resume 100% in Measure B for council's future distribution. But we would just be making that modification during those 3-year period for consideration.
And if I could, Lauren, just to maybe put a fine point on the potential uses of those Measure B funds. We've referred to it as bike ped, but the Measure B guidelines actually refer to the allowable uses. I believe it's congestion relief. And so we'll need to, and there's a prior approval required by VTA before a city can use it for other types of projects. So there's a process involved there. And so don't want to assume that we can always make the case that a bike ped project is congestion relief. So just wanted to flag that as something of a constraint on the city's flexibility on how those funds will be used.
Well, let me add even a little more context to that. So when we were negotiating the Measure B in 2016, then Mayor Liccardo had really wanted to carve out the funds for basically street repavement. San Jose streets were in poor condition. I actually negotiated that that's fine, but not all city streets are in poor condition. Ours was in, at that time, up to maybe low 80s in the pavement condition index. We're now at 84, which ties us for the best in the entire region. We don't promote that well enough, but as much as our streets are not perfect, they are tied with one other city for the best in the entire Bay Area. And so the argument was that if you were above a certain base level of PCI, and I think it was like 75, you would have latitude to use it more broadly. And we've used it, allocated or much of it for this bike plan purpose. On the one hand, I'm glad to hear it's a fund that we have developed for it, but these are not new dollars that are being saved from the budget. This is just a cash flow reallocation. And my understanding from this committee and from the council was that we were directing to have these in expenditure reductions. And I don't think of this change as falling in that category. And I would not want to reduce our whether our current or future bike and ped expenditures on that basis. We're just getting ready to hopefully approve a bike and ped plan, and it's going to require significant investment to implement it. I don't want to see that as something that as soon as we adopt it, we reduce the implementation funding.
To me, it's a nonprofit.
Okay. Keith?
Okay. Yeah. So effectively what's happening is we're kind of borrowing that million. If we eventually have to repay it, then we have 2 million more in debt. Let's see. So on slide 6, the rental and reservation fee revenue, we're going to get 100,000 extra. Are we raising rates or are we reducing vacancies? Slide 6. How are we generating more revenue?
So we did on May 7th, related to the updates, that based on the analysis of that rate increase that was updated.
Your mic. Oh, did it die?
Oh, same thing. That happened with Ed last night also.
That better? Okay, great. Yeah, I think staff just analyzed the revenue relative to the GRA increase that was on May 7th. The GRA increase was 6.8%. So based on that, it's the proposed budget has more capacity.
So you're just saying you sharpened the pencil a little bit.
Yeah.
Okay. How many vacancies do we have in our rental? Is that something where if we worked hard on marketing, we could squeeze some more revenue out of that?
Good afternoon, Kristen O'Kane, Community Services. So the question was, could we do more to rent our facilities to bring in more revenue?
Yeah, if we had vacancies, right? If we're full vacancies, then we don't have to market.
Weekends and evenings were pretty full, especially on weekends. Our facilities are booked a year in advance. Where we have less reservations is weekdays during the day. So we could certainly look into bringing more in. It's just a difficult time. So we do use that time to program some adult classes and programs, which doesn't bring in rental revenue. It brings in programming revenue.
Okay. Which is a different pot than we're showing on the slide. Okay.
No. Yes.
Okay. At one time we were looking at, there was some interest from businesses to do video conferencing and stuff like this. So they need a bigger space. Like you have a small startup, but you now have a meeting with investors or clients. And there was some interest there, but we didn't have any telecom capability. Have we done any work to see what that would take or what is required? This was 10 years ago that there was interest.
Yeah, I haven't heard that. So no, I don't believe we've looked into it. I think we'd have to improve our AV equipment. But if
Yeah.
there's a need and that's
This-
something we
This
wanted
is
to
back when
look
Rob
into.
was still here, so it's a while
Okay.
ago, right?
Okay.
But he was getting pings. Startups were asking, can I rent some space? He said, yes, you can rent space. Does it have video conferencing? He said, no. But nowadays with computers and Zoom, maybe we don't need that. And so maybe outreach to the startup community would be worthwhile to try to do the weekday rentals.
Okay. Thank you for that.
Okay. The next one was slide 7, please. Okay. The BSR balance stays fixed at 54, but our budget is continuing to grow, so that we're slipping. And if the bottom right there, we're down to 17%. And, you know, we're earning 2.5 million a year on that interest of the stabilization reserve. So even if we just took the interest from the budget stabilization reserve and kept it in the BSR, we'd be up at 56 and a half in 2027. So I would really like to see that go up. We don't necessarily have to get up to 18.5 in one fell swoop, but I don't quite feel comfortable staying at 54. I don't know what other people think, but
Well, first, that kind of a budgeting principle of whether the interest would be a way that we would keep the BSR more stable as a percentage of the GF would subtract those dollars from expenditures for the GFs. It may be a good kind of way to do it in principle, but it doesn't create new dollars.
no.
Yeah. But I do have a broader related concern. We had created this uncertainty reserve a couple of years ago because we had highly unusual surpluses, because we had been holding back on restoring services that were slashed during COVID. And as the recovery happened, then suddenly we had a big reserve. And if we didn't put that into reinvesting, we'd still be not having restored so many of our services, public safety, libraries, et cetera. But as we've been grappling with the projected deficit over the next few years from now through 2030, or up to 2030, I think it was, provided that we don't do structural reforms in the meantime, it would shrink all those several years of deficits. We're still showing two different reserves, and we're having our traditional budget stabilization reserve, and take that literally. It's a budget stabilization reserve, but we're not using it to stabilize the budget. We're using this other uncertainty reserve to stabilize the budget. And what we're actually doing is reducing the budget stabilization reserve, but not saying that we're doing that to balance the budget. I think we're overdue to fold these together and look at what should be our budget stabilization reserve. And kind of we're just moving things around in a way that adds to confusion at this point in time. It served a purpose because if we had 2 years ago $40 million in extra in the BSR, we go, what do you mean? We're 30% or whatever it would have been, or 25% of the budget in the BSR, and that would have looked goofy. But it served its purpose. And I think we need to go back to, let's fold these dollars in, and connected with that, as we look at our FY27 budget, and I don't know if we have a backup slide that shows our current long-range financial forecast or not, but we have these other upcoming years with certain projected deficits. And we're going into FY27 with basically a projected 8 million deficit, of which we would use 4 million from this uncertainty reserve. And then in some ways, we're using some from reducing the budget stabilization reserve from 17.6 to 17%. But it's not clear to us how much that is in dollars that we're using to basically plug an FY27 deficit. I'd like to see two things. From an accounting standpoint, we just go into one reserve, back to where we are. It's not going to be throw our BSR out of whack by adding 6 million and then in 27 adding what might be 2 million. But the second thing is that we aren't dealing with the structural deficit in FY27. And as we all agreed, we're facing a lot of economic uncertainty. And we're going into it with an $8 million reserve. I mean, deficit, basically. I think like what we did is set as a goal for staff of reducing 6 million from this year. I'm thinking of perhaps that we put as the goal for, we set out an early goal so that we don't wait until the budget cycle comes up and we tell staff, no, what you came up with is not what we want to do for FY27, come early May next year or whatever. And we say we want to reduce 4 million and cut that projected deficit in half. Given the uncertainties, I think going into a year with great economic uncertainties with a deficit and a couple years after that projected as deficit is something we shouldn't be doing, or that we should be trying to mitigate, even if we can't eliminate it. So that's something I'd like my colleagues and to think about as this day goes on, or you might have early thoughts.
Chair and committee, before we leave this thought about combining or discontinuing uncertainty reserve, because it served its purpose, I think, Paul, when you combine the 2 million into the 54 million, how does that change the 17% ratio?
That would put it up to about 18.2. So the note at the bottom of the table, it says the BSR to get to 18.5, you'd need 2.8 million. So you're getting most of the way there.
Yeah, so it would take us to what we've just about what we've had as our target of 18.5%, which is not the middle of the reserve. The reserve is 15 to 20, but this is what we had set as a target. And we recognize that it's a target. It's not a necessity. So that's one thing. And then the other consideration, given the uncertainty that we have ahead, is if we had negative economic impacts this year and next year, and we are projecting that by 2030 we get back into the black, that goes back to this question of additional debt finance. And we have the Fire Station 4 that currently we'd pay for out of cash. And I don't know whether there are any other significant capital expenditures projects that would be candidates for grouping in a COP, even if they're not at the scale of Fire Station 4, but they help spread that fixed cost of the 300,000. As we heard earlier, this isn't as advantageous of a time to debt finance as it's been several times in the past, and that's certainly a consideration. And so I'd be interested in two things. One, whether we want to think of that as our ace in the hole this year if things turn south. That we don't necessarily do that right now, but we keep it as the one way that if things turn south, we're not going to be, we could bridge perhaps 15 million, or if you take 3 years of debt service off of that, 12 million or whatever of cash flow, that would be one way to do it. Connected with that is, given the timing on the Fire Station 4 construction, when would we have to make that decision on whether we would do a debt service on that?
So can I,
Staff's going to need to look at that. I
Yeah.
presume, I don't think we're ready in the moment to.
I just want to paraphrase back, the discussion is for staff to analyze, should we move forward with debt financing, in particular Fire Station 4? When would we need to make the decision?
We should do so in response to deteriorating economic conditions.
Okay.
If we said today we want to finance it, how much paperwork delay is there to actually get the money? Is this a 6-month process or 1-month process? What would be the?
I don't know if we
May,
could give a ballpark, because I think we're doing something similar for grid mod. So what's that project timeline, just to give Finance Committee a sense?
If I may add, just to do the bond issuance itself, it takes about 3 to 4 months itself. The decisions about the projects and stuff may add additional time.
Okay, so a minimum of 3 to 4 months.
Sorry, could I respond to your notion that we might combine the two reserves? I guess I really see them as kind of catastrophic support, like COVID level. Oh my gosh, massive change in our revenues and expenses, versus shorter term, easier to manage deficits. And so I like keeping them separate for that reason. And just wonder if there's any merit to that, or if it does make sense to say, you know what, let's grab that 2 million left and put it in the BSR. The other thing is, I know that we budget conservatively, that we often end up with surplus at the end. The surplus gets shipped out to the BSR to get us up to the 18.5, and any addition goes to the Section 115 trust.
No,
No?
it had been by formula half toward supplemental to the capital program and half to the Section 115. And just on your other kind of that, the uncertainty reserve being this exceptional thing, it was. But now we're entering FY26 and carrying it into FY27. COVID's pretty far behind us, and it's a diminished amount, and we're shrinking the BSR, but keeping this other one. And it just, I think, creates confusion for a fairly nominal difference. I think it's outlived its purpose.
Okay, I get
And
it.
I was okay with it
Yeah.
when it was 40 million and 20 million and
Yeah.
those things.
I kind of view the uncertainty reserve as training wheels, and that we have this ramp of property tax that hopefully will bail us out down the road. And the uncertainty reserve can be bled down to get to that point. Independent of that, we have a standard BSR just for another COVID or another issue. And so I don't have any problems either way, but I think we need to have appropriate reserves, because if anything, we're more uncertain today than we were a year ago. So I think that I'm a little nervous, even if we kept the level of reserves constant this year. I think we may be wishful thinking that nothing bad's going to happen.
And that goes to wanting to make sure that the reductions in expenses that we were looking at were it was a combination of cash flow of reducing the capital improvement expenses in a given year. What could we curtail? And you gave 3 different percentage reductions as scenarios, and other actual cost reductions. And what we've got is, to some degree, we had it's going to come out, but there was something that's still not clear to us how much of the FY25 surplus was in that 6 million, and this million or so from being transferred from the bike and ped fund to street paving, which is not really a saving. And so I think we need to go back and make sure staff is actually having those reductions align with what we understood to have been the direction. And then be thinking about our contingency planning. And to me, that's part giving this early direction to reduce structural costs for FY 27 by maybe half of the projected deficit, and to keep as a possibility some additional debt financing for major capital projects, primarily Fire Station 4. Those are the three steps. Deeper cuts along the lines of what we thought we were asking for, and reducing the projected deficit for FY 27, and having the potential from a cash flow standpoint to do debt financing to help us bridge it. Those are the kind of two higher level strategies that I'm interested in.
Chair and committee, I'm sorry.
Oh, I was gonna have a quick follow-up. How liquid is the market in bad times, like during COVID? Would we be able to do that financing during COVID, or was that market kind of locked up?
Is a question relating to our ability to borrow and finance?
Yes.
I don't know if I could, are you talking about back in COVID time or going forward?
What I'm worried about is if something goes bad, I really think having this financing in our back pocket is another way of having a reserve.
And I'll add that during COVID, the federal government said, we want you to borrow whatever you can, and we'll almost give away the money. And so we don't know what federal fiscal policy would be under this administration. I certainly wouldn't count that it's going to be similar to what it was. So that's part of the uncertainty. But then you've got really the question. So that's federal policy affecting that borrowing. You were asking what really the private market does.
Like when long-term capital management went under, could we borrow it at that time, or did the markets freeze up so that if we had a need, we wouldn't been able to borrow it?
During COVID, that's
may
the
add-
time we issued the certificates of participation.
I think he's talking about the Great Recession.
Oh, back then. Well, again, I think I actually heard something earlier today that pointed out how difficult it is to correlate the economy with the interest rates. And so I suspect that there may be not much you can draw in terms of conclusions.
So in general, bad economies mean interest rates go down unless you have a stagflation bad economy. But ever since the early 80s, there's been a correlation between a down economy and downward interest rates. And we have both the federal government fiscal policies that may or may not help, and I wouldn't count on them in this cycle. And then you have Fed policies. And the Fed policies are really what have been the driver of reducing interest rates when economies are down. But
If I may add, I've been overseeing the debt issuance for the city for about 26 years. We have, as mentioned already, we are highly rated. We are low debt issuer. So the city of Palo Alto bonds are very highly desirable. So there isn't an issue that we couldn't issue the bond in any given time. The only issue is what has already been mentioned is what the interest rate is at any given time, what the rate we will get, etc. Lauren had highlighted if we issue a lot of debt, it may potentially impact our rating down the road, and that will tie into what the rate of the bond is. So I don't think we'll have any problem selling bonds for the city of Palo Alto. It's just a matter of what terms we will be able to sell it at, depending on the market condition.
And I am not anticipating that if we did kind of the additional debt for Fire Station 4, that's not going to materially impact our bond rating.
Yeah.
Can I say to Tarun, thank you for your 26 years of service in this important role. My question for Lauren or Ed is if you could just remind us, what is our exposure with regard to federal dollars? If the looming threat is potentially a pandemic, but also potentially the feds deciding to treat a city like us differently. I just can't remember ballpark what those dollars are in a typical year or an averaged annual.
Well, I'm not prepared to give you a figure on that, other than to note that while we have grants, the grants are not either expended or due in major lump sums. They're expended over a period of time. So I don't know that that would necessarily be a way to look at our risk per se. But in any case, feel free, Lauren, if you'd like to add a perspective.
I concur in that while there are impacts, because the federal government is, has an impact at the local level, for us, our budget operationally does not rely on federal funding. Most of it that we do get relate to grants for specific projects, and we are working closely to making sure that those go through and making sure that we don't commit monies that won't be reimbursed down the road. So does that help?
It does, but the county is,
Exactly. I think a perfect
Yeah.
counterexample, we are not the county. Thankfully, we are not
we're
reliant.
not the county, but we rely on funds from the county. So I'm wondering about the trickle down.
Not in the
right.
same way. So the county's heavily dependent on Medicaid as an example in order to run the hospital system, which is a integral and largely lion's share of county expenses. We are not dependent on county revenues other than as a pass-through on things like property tax, and so do not have that same level of exposure.
Correct.
Or like the transitional care, transitional housing, that has county
grants. It has grant funds for the construction. We are anticipating county funds to a certain extent for operations, but ultimately there is, these are decisions that can be made on a fiscal year basis should there be any interruption on the cash flow.
But I'm nervous about if the county pulled out and now we're left, do you shut it down or do you fund it yourself? We'd have a lot of pressure to fund it ourselves.
Agreed.
So I think the trickle down still is there. Maybe not quite as direct, but still.
So Chair, I think in committee, what I heard in the last about 30 minutes is really going back to this concept of like big knobs, right? What are some moving parts that we really want to continue to focus on? So certainly our reserves, whether we call it uncertainty reserve or BSR, is maintaining a reserve level that enables us to be responsive. Having heard this conversation and giving context to the background of uncertainty reserve, it seems that at some point we may phase it out because there's a lot of discussion back and forth when the amount may not be as influential in these two buckets. Today in this adopted budget, don't know if we really need to make those actions, but good for the context of this conversation, because if we combine them, that changes that 17%. And so good to have the context, and also good to hear that this committee is kind of thinking flexibly about that. I think maybe when we come back, close to when the AFR for fiscal 25, and we know how we might exit the year, that might put some context into the UR or BSR, and if we combine the two. But good to understand that this committee is thinking that as a big knob, maybe we move away from that to simplify our conversation at the policy level. The other aspect is debt financing and the concerns about like in a downward market, what would happen. I think partly we would also look at reserves on hand and continue to maintain our high credit rating, because that high credit rating is really what enables us to exercise debt financing swiftly and then also with low cost. So all these discussions we have around fiscal diligence really supports our ability to pool financing when we need it, and have a market that really is receptive to lending to us as a community. Last but not least, we are continuing to monitor, and should the situation evaporate and get worse, we would certainly come to you more quickly. As I mentioned earlier this afternoon, in June. I think council on June 2nd or 3rd. On Monday, you will be receiving the Q3 report for the current year that will show what we've received in revenue and expenses and some of our projections. And so June 3rd. Yeah. And so I have been reviewing that report with staff. And so kind of to complement what you're talking about, which is, we are continuing to monitor the uncertainty around the situation and make sure that we can continue to forecast closely what's happening. So nothing that we have received to date changes what staff supports the direction of the council thus far, which is to retain half of uncertainty reserve and come back with a plan to manifest those savings in capital and expenditures.
Looking at slide 7 again, when I look at that right-hand column, in the bottom right there, I would want to see the total reserves, both the uncertainty added with the BSR to total 58. I think that would be a reasonable target to go at. And so that would mean that we'd have to find that's at the end of 2027, right? So then that means we have time to figure out how can we cut our costs further.
Also,
Yeah, you'd have to find 2 million.
so
I was talking about even 4, but.
Okay.
Yeah.
Oh, yeah. Oh,
Yeah.
I,
Well, I mean, those are arbitrary numbers, but important ones.
yeah. And the reason how I came up with 58 was we had already done this 642. And if you do that 642, but you maintain your BSR percentage where it is today, then that would be another 2 million. So that's where I got the other 2 million. But
My concern, and that's where I was talking about the long-range financial forecast, is that we have this 8 million deficit projected for 2027, and there were deficits for FY 28 and 29, if I remember correctly, and they were declining to 2030, going into modestly in the black.
okay.
And that's why I was even more aggressive in wanting to not go, to just try to address those structural deficits on a gradual basis.
Yeah, that would be better.
Yeah.
Complementing the conversation about and the concept of a gradual basis, while we don't do a 2-year budgeting process of an annual budget, we do look at multi-year. Having heard that the committee wishes to make our reserve more robust, I think that's really good feedback as we work towards closing out this current fiscal year. I think that's good feedback for us in ASD to think about any type of savings. A portion of that should be going towards shoring up our BSR to get that percentage ratio higher. And then anything left might go towards shortfall, CIP, or otherwise. But that sounds like it's an immediate priority as a top line need, and then everything else is subsequent. Is that a fair takeaway?
I think what's important is that we have to cut our ongoing expenses. And so this gives us, during this next fiscal year 26, we should be looking at non-essential positions. If they open up, eliminate them so that by the time we get to 2027, we have this 4 million extra.
And certain consulting contracts and any other knobs that can be turned. Yeah. And I will say, out of this discussion, we also basically, what you want us to, at the end of this meeting, to be voting on recommendations from the parking lot. I think we've already identified that we don't want the transfer from the bike fund of Measure B to the street paving. And we'll yet vote on it, but tentatively so. I'm seeing heads nodding.
Chair, can I clarify? That fund right now is not necessarily bike fund. It's just Measure B fund balance.
Okay,
there.
and we can put it that way.
Okay.
Yeah. And then just you weren't able to give a number, but we want to make sure that we're not including any anticipated FY 25 surplus in that 6 million in reductions that we're looking for FY26 on.
Right. So of the 26, of the 6 million, that needs to come from 26 onwards, and leave the fund balance carry over as to be utilized and appropriated otherwise. Before we move on to nonprofit, may I clarify, because we do want to put this together for council, would Finance Committee be receptive to us moving that 1 million down to deferred CIP as a placeholder? So we do need a placeholder somewhere. So is it okay if we make that 2.2, 3.2? And again, staff has an exercise to come up with all the projects. We may or may not be able to, but we don't want to disappoint the committee. So given that we're going to strike Measure B, we just put the 1 million in CIP for now?
Here's what I'm trying to recall from our last Finance Committee meeting. What was it that we were looking at 4 million in one-time reductions and 2 million in ongoing? And so I don't know how that fits into that formula. Yeah.
We would still have to adhere to both of those. There are two standards to meet. One is a minimum of 6 million and a combination of 4 that's one time and 2 million that's ongoing. So we haven't
Right.
lost sight of the objectives. And so for now, these are placeholders.
So if you were to put it in that CIP category, I just want to make sure it stays with that. It still pencils to the 2 million ongoing, 4 million one time.
Correct.
Okay.
Correct.
Okay.
So we'll now revise the parking lot. So it's 3.2 million of placeholder for deferred CIP with 2.7 for for general fund expense savings. And we'll come back with the detail on August 19th. It may be a different combination to meet those guidelines or expectations. They're more than guidelines.
Okay. So we have on page 8, the nonprofit work plan, and staff laid out our previous recommendations, which included direct allocations for the 4 nonprofits that were directly funded last year out of a deliberate additional funding. But then we had the council discussion that seemed to not wanted to give Policy and Services Committee the latitude on how to allocate the funding for this special category of nonprofits. And that would include the additional funds that we had added, 100,000. And then staff has clarified that the PSI, which is PSI? YSI, excuse me, too many acronyms. Program. YC. Okay. I'm not the only one. Youth Collaborative Initiative. Connectedness Initiative. That's actually back in a line item in the budget and not part of that policy and services, correct?
Well, the budget staff, I think, will need to confirm how it's shown on the tables here. But factually, let me share that we do have a proposal from YCS for what's now called Youth Connect in the group of proposals that the Policy and Services Committee will be reviewing.
Well, my understanding is that that went in because there was ambiguity at that deadline, but that what we had received in clarification at our last budget meeting or the finance committee was that staff said, no, we had made an error and it was coming back into a line item, was my understanding.
I think
It
it's
would not be part of that. That it was, you got that application because there was a whole bunch of ambiguity, and at the last minute, it was told to a bunch of organizations that they needed to apply to that at the last minute. So that's part of what's been my concern, was that there has been a whole bunch of confusion on this whole effort, well-intentioned effort to create a greater a process for these sorts of allocations. And I just, before we kind of go into that particular one more, I went back and looked at and say, okay, what's the genesis of this problem that staff's trying to solve? And it was the 2022 nonprofit audit risk assessment. And there's both the full report, and we haven't been getting a bunch of these documents as we've had this reconsideration. We weren't seeing the references to how do we get to where we were and what was the problem or problems we were trying to solve. So there was an attachment when we had this review in the fall, I can't remember the date, there was an attachment that was a summary of the management review audit recommendations. And there were three, I can share this around, I don't have multiple copies. Basically, the agreement should define service level expectations. Second, that a high risk agreement should be appropriately sourced and closely managed. Third was the city responsibilities in the agreement should be achievable and to avoid non-compliance. And four was the city should track and evaluate performance. As I went back and looked at those are all directions to staff on overseeing the grants that were made. They weren't directions to come up with new criteria for awarding grants by the council, or how we would determine who had those merits. So we have a disconnect between what the audit was saying needed to be done and what we've ended up with here. And that was really interesting when I went back and looked at that, because what we've been told is, oh no, this whole program is to meet the obligations of the audit and et cetera. Then I went back, and as part of, I think it was that same staff report, there's an attachment B, which is the nonprofit service agreements of $10,000 or more citywide in fiscal year 25. Because when we have the HISRIP projects, which I think there are 28 different nonprofits that receive HISRIP funding. And then we had these 4 in the budget, and we said, well, these staff that we had 4 that were in the budget in the, called it, the general human service contracts. They included Avenidas, Palo Alto Child Care, mediation, and the YCI. And then we had these other 4 that we had budgeted last year. Well, come to find out, this attachment B shows all these different entities that we, as a city, have over time built into the budget. We have the discretionary HISRIP ones, but there are 20, excluding the 4 that we had added last year, there were already 22 others at different places in the budget, including, we heard last budget meeting, well, Project Safety Net wasn't part of this discussion, and it was in this allocation under the general community services budget. But ones like grassroots ecology, we have Canopy. This was, I think it was the fall. August. No, I think it was in the fall of 2024, that council meeting.
You're referring to the study session that we held.
I think
That
that's where it was an attachment
yes,
to.
it was taking next steps
So I've got
on
two
nonprofit
attachments I have, but
relationship.
now I was looking at so many different things in the record. I think that's where these two came from. So it goes through a whole list. I'll let you guys see this. I highlighted the ones that are non-HISRIP. There's a column actually that whether it's HISRIP or not, and there's an X on all the HISRIP ones. So we actually write, huh? Aha, good. Okay, thank you. So that was fascinating. This whole discussion that these four that we had last year said Magical Bridge, UNAF, Third Thursday, and Environmental Volunteers, that this was such an anomaly, and it's not. We have all throughout the budget a whole bunch of nonprofits that provide vital services to the community that we've been partnering with for years. And we added or consolidated four of them last year. Actually, they weren't new to last year. We just put them in a clearer category. Third Thursday had been funded through other funding the year before. UNAF had been receiving some funding. The Magical Bridge was new. Then I'll add, oh, you have it or no? Okay. And then the other context is the process that has now been set up for not only those four nonprofits, which initially staff had said, oh yeah, we're going to put the dollar amount that we funded those for into a different, into a special fund, and that's going to be allocated by policy and services. And staff thought it was the exact same dollar amount as we had done last year, but now it's been opened up to every one of these other nonprofits with a whole bunch of confusion. I can tell you, I've spoken with a couple of them. They were at the last minute going, what, we're supposed to apply to this? And so now what do we have? 20 something applications. And I went and compared what had been a co-sponsorship application that we had before. Here you go, Keith. In 2016, which was a pretty streamlined application, and maybe it needed to be improved. And then the one, what we were told was a simple application that's going through this allocations from policy and services. And I heard from nonprofits going, this was a big effort to fill it out, and we couldn't even complete all this stuff, and asking for different things that were not readily available, and you know, it was a big application. And then I said that, okay, once again disclose that my wife serves on the YCS board and receives no compensation. The applications, we had heard that, well, some didn't make the deadline, and that's in flux. There were a few that didn't make the deadline, and I found out a little more what happened there. These were ones that the last minute hadn't had notification that they were supposed to apply for this, or eligible to, or even supposed to continue getting the funding that they had before. Well, Ed, I'll mention, for instance, one was Neighbors Abroad.
There are two, Neighbors Abroad, and I believe it's a PTA-related organization.
Okay. And so we have, how many applied?
Neighbors Abroad
Total?
put in an application for supplemental funding beyond their current city contract for hosting delegations in town.
Yeah, but we had 20 something.
Total of 22, I believe it is,
Yeah,
or 21.
so that's just an example. And that one, that's an example of a couple that had allocations previously through other means. They were getting compensation through the city manager's office for those expenses, and were told at the last minute to do so. The point being that, like, even them, they found out on the Thursday that they were supposed to apply, and now it's not quite so sure that they were supposed to. They rushed to get it in, got it in on Friday afternoon, and then we're told, oh no, the deadline was 3 o'clock on Friday, not 3:30 when they put it in, not end of business day, not at midnight, like a lot of those things. And somewhere in the form, there was a reference to the 3 o'clock. Point being, this whole thing has been confusing at best. And I don't believe that as the council, and I tried to make this point at the last discussion that we had, and it's even more apparent to me now, that we as a council just, and I don't even think staff, everybody was fully aware, these are the ramifications of what we're doing. And so I wanted to put those additional pieces of information on the table. We still have, council gave direction that it's policy and services who's going to recommend to the council how those dollars get allocated. Now that goes back to the staff report, which is confusing. And my understanding is that when I saw this in the staff report and some nonprofits saw it, they said, oh, our funding's back in as a recommendation, but city manager clarified to me that that's not the intention of the way it's listed in the staff report, which is those were our recommendations, but it did not revert to that the way we're headed is that these nonprofits would have line item allocations in the budget, and then that 100,000 would go to P&S to decide among the others how to allocate it. Instead, it is that they would be deciding what funding these groups would have as well as those others.
What is the path forward? Policy and services will allocate it, and then they'll come to council, and then we'll discuss whether
They'll
they're
recommend allocations is my understanding.
And isn't
That's
our
correct.
job to figure out how many dollars they should be able to allocate? I mean, right, that's my biggest, thank you for doing all this sleuthing. You really did. I mean, the stuff is all over the place and baked into the budget in various places. And, I think if we recall, what prompted this was a concern that Ability Path had come forward with a very large request. And we realized at that point, how do we know whether to say yes to this or to some portion of this without knowing who else we're saying yes to and no to? What degree of relationship would this be if I think they wanted $250,000. That's that's on the high side in terms of our support of nonprofits. And so then we've got the long-term partners who don't really need to apply year over year. We've got the HISRAP people who apply regularly. We've got, 4 that are showing up in the CSD human service contracts. We've got these other 4 that seem to not be anywhere. We want to make sure that, that Magical Bridge, Environmental Volunteers, UNAF, and Third Thursday. We had the snafu with YCS, YCI. Where is Project Safety Net? And I feel as a finance committee person that the $100,000 remaining to allocate to P&S to distribute across the subset of the 20 that did not, were not part of the 4. It's so complicated. I feel like our job is to allocate the dollars, and P&S's job is to sort out the complex nature of the city's support for nonprofits. Who has to apply in any given year? Who's baked in? Where? That feels like an enormous project, and it doesn't feel like our project. But I think our project, my thing is 100,000. It's not enough.
Well, but then we have these other 22 nonprofits that are actually elsewhere in the budget. And the question of, it was presented to us as if these 4 were anomalous, but actually they're akin to the other 22 that are in the budget. And there are 2 decisions, 2 paths. One, it goes into the free-for-all, which was not only those 4, but all these others that might get additional funding beyond what they were previously expecting. Or that the council says, no, the ones that, which of these are fundings that are akin to the other 22 that are in the budget that are ongoing commitments to by the council, ongoing but not guaranteed permanent. There could still be decisions in the future that would change it. For instance, Project Safety Net, we used to fund at a higher level, and then when they spun off, that became the 100,000 a year. So things do change over time. I don't mean that it would be locked or written in stone, but it is a important policy question that is also a budget question of which nonprofits are actually in categories for ongoing funding versus competitive funding year to year. And we did have that discussion that so another point, I'm sorry, I've got so many going on. Oh, there is one other that I wanted to point out about the difference between the audit recommendations and the structure that we now have for the application for those dollars. And the application is very focused on diversity, equity, and inclusion in the criteria. And while those four that are in we're discussing actually do have very strong components that way, that was never the auditor's recommendation. It was not really what a council gave direction on. That came out of staff. The council didn't really discern that, but a part of it was that we didn't have that discussion on context. Diversity, equity, and inclusion to me is an important part of what we do in our considerations of who we support, particularly in nonprofits. But those supports are about supporting our community with an additional lens of diversity, equity, and inclusion, not as that being the primary basis for supporting community nonprofits. But that's it's been reversed to that seems to be really the way it is framed there. And so I just wanted to raise that consideration as well. I will note, as I said, we think about the project safety, or excuse me, the Magical Bridge funding. Well, that we elected to do that because the case was made to us in budget last year that out of our diversity and inclusion and equity, we really weren't thinking about a disabled community, physically and mentally disabled, as an important part of those communities that we want to support under that guidance. And that was what was compelling to us. We said, oops, this is really a great program, and it really does address that. The UNAF is educational, and it's based on the UN Declaration of Human Rights, and it's all about those sorts of human rights themes. And it has other aspects to its value, just like Magical Bridge has other aspects to its value. So it's not a single box that it checks, but those are major ones. Third Thursday was originally thought of as entirely economic development. And now we've said, well, it's both. It's community development and belonging and economic development. So it has a component that's there. And even the Environmental Volunteers Program, I know, has a very strong inclusionary component. So it's not that it's either or on these, but I do want to point out that I think that we have not only set up this convoluted process, but what P&S is going to be evaluating as criteria is not the same as answering the question of what nonprofits are most important to the community that we would want to fund, with a consideration on whether they, as part of that, are addressing diversity, equity, and inclusion. And I think we've reversed the process. And so the criteria, I think are problematic as well. And I don't think from anything Policy and Services has relayed back to us that they have been considering this whole series of things that we're talking about.
Who sets the criteria? Is that Policy and Services or is that staff?
It was staff recommended and
And
accepted
discussed and
by
approved
PNS.
by the PNS committee as a recommendation to the full council, which the full council has now said, let's give it a shot. Now, the good news is this will all come back to the council on the 16th for you to reconcile, and you can either agree with PNS's conclusions or as a council, you can decide that you'd like to modify them.
I will say that we still have that ultimately as a council, but I want to lay out on the table, once you have something that is really off kilter, it's tough to unravel it and undo it.
That said, Chair, I would have to say I disagree with several of the points that you made in your original comments. I would certainly agree that there was a miscommunication with YCS on their continuing contract. That amount of confusion, I think I would certainly agree with, but I wouldn't describe our situation as rampant confusion. And as such, and there are a number of other points, but again, I don't want to get into a point by point. I would just want to express that difference of perspective on how we got here and where we are.
We will agree to disagree on that one. Okay.
And I'll add, I also have heard from nonprofit leaders that they are feeling confusion or uncertainty about what is it we're supposed to be doing. You know, are we aware of the various buckets of money that we might have access to? And, you know, so I think for everybody's sake, something clearer sense of the buckets or the types of relationships we have, you know, is I think a goal we all have. And the additional concern I have is the extent to which somebody might be double dipping because they are getting his rep and they're also applying for money, you know, from another bucket. Is that allowed? Should it be two different tracks, or is the overlap fine? I think it's an example of the type of confusion that an organization might be feeling if they are a his rep and have been encouraged or informed about this other bucket. It makes you worry about those who aren't his rep, who are only aware of this other bucket. You know, it makes you wonder about the overall equity of who's getting what percentage of what they ask for. Some are getting 100%, some are getting 60%, some are being denied. And it just feels, to the outside world, to the nonprofit leaders, I think they're going, we need more clarity from the city of Palo Alto.
Well, and so if I might
Please.
respond to that, I would note that this is one of the reasons why we have been using this really clunky title, Nonprofit Partnership Work Plan Phase 1, that it is as clunky as it is, because the Phase 1 is the operable term here. This was part of not only the audit, but I think you're actually reminding me that this relates to the discussion that you've had as council members on the question of his rep. And do we want to increase the total funding to his rep as a percentage of the budget itself? So there's that bucket of both policy issues, which organization receives the funds, and then ultimately, as it relates to his rep as an example, how much money does the city want to allocate to human services as a percentage of the overall general fund? So the focus on funding allocation to services of different types is that larger or resource allocation more broadly, the biggest sort of umbrella under which we are trying to rationalize the various points in time and methods during which or through which the city has made both funding decisions, as well as was also pointed out in the audit, we make decisions through use of city facilities and the implicit subsidy associated with that. So those are just a few other examples of what this work plan has had this step as a means of stepping forward.
I agree that, we've had this issue on funding levels for human services, and as Finance Committee, we worked hard to increase that. But not all the nonprofits are in the human services category. And we've kind of been, that's another area that we've been in this process confusing about. I will say that when this came to the council and the staff recommendation was for, I think, the 235,000, or was it maybe even less? There was a confusion there. I don't think any of us on the council envision that that dollar amount that exactly equated to the 4 that we had carved out for funding last year as line items in the budget, that they would be 4 among 20. I do not believe anybody, not a single person on the council, understood that's where it was headed.
Yeah, great.
Yeah. And and I did just on the application, what I've heard from some of the nonprofits, the application for that new category and funding for it, and how complex it was. I know that staff believed it was simple, and that's how it was conveyed to some of those. And then nonprofits did it, and they said, far from simple. And that goes back to kind of a user experience. We can have one point of view, as staff says, oh yeah, I put these dozen questions or whatever it is, and that's pretty simple. And then, but they're not the ones having to fill it out. And so I think that that's another aspect that we've got to reconcile, the point of view of those requesting information and the reality of those who are having to supply it.
And to reduce confusion, I think, why would you have, if you have his wrap already, why would you have this other bucket that would also allow human resources to apply? And why wouldn't you have 2 separate criteria and have them separate and no crossover? It's hard enough to dig through all the nonprofits and grade them and compare them when they're in 2 separate buckets as opposed to now having a combined bucket. But when I look at this list, I mean, there's so many good nonprofits here. I just feel like someone has walked up to the buffet table and say, I need a bigger plate. And I think that, we're cutting, but yet these are small amounts compared to some of the other budget items.
Well, and that the kind of the basic concept is that, and we've talked about this, and city manager has talked about that, to what extent are these us providing funds to these organizations, and to what extent is it leveraging what the city does through partnering? Leveraging in terms of those entities being able to raise additional funds as a result of the city contribution, but also just providing services that would cost us far more if we were to attempt to provide them through city staff, and we just wouldn't be able to do it. And so for me, it is generally an extremely cost-effective way to provide services to our community that are valued and needed, as opposed to hiring more city staff to do so. And we would provide far less in the community if we did it that way. And of course, every community has a certain number of nonprofits that they support, but that at both a kind of a philosophical level and then a more practical level, that's certainly how I view this consideration. Now, we always have to set boundaries. It's not limitless, but that's the context that I view it.
Well, and if I could add one other context, on behalf of your professional staff, I think it is only appropriate for me to share the perspective that in times of fiscal constraint, ultimately, public agencies need to reflect on what are our core priorities and how do we use the resources we're provided with to pursue those core priorities? Much of this discussion, and understandably so, has focused on organizations we want to support, and that's completely understandable. At the same time, ultimately, these organizations provide services, and it's those services that are the responsibility that we are entrusted with pursuing with the funds available to the city. So, the criteria that were used and presented, discussed by the Policy and Services Committee to be used in this cycle were a first attempt, again, based on the City Council's priorities as the rubric through which to evaluate the proposals. They do not directly align with which organizations we want to support as worthy as they may be. So, again, the Policy and Services Committee will be meeting next week for a first review of the applications, in addition to the meeting that is scheduled on June 10th for them to do the deep dive and evaluation and deliberation on what recommendations to bring back to the full council. So just want to acknowledge that effort will proceed in parallel.
And the point about alignment with council priorities, that's one that I am concerned. It's an important component, but that was another one of the concerns I had with the application, was that it overemphasized council priorities, which priorities I agree with as priorities, but they're by definition focus areas over a certain time frame. They're not, as the city manager has emphasized, what we do as core functions, and they're not all of what we've also had this separate category of enduring values that are these basically city values that are not within the 4 priorities supposed to last 3 years. And I see a number of places we keep trying to shoehorn efforts and focus areas that we do within the priority context, which very much they provide a context for additional emphasis, but they're not all that we do as a city. And so I just don't want to overemphasize whether they fit within the specific priorities to qualify. It's certainly one of the considerations.
So where does that leave us as a finance?
Do want to clarify that our understanding, staff understanding, is that the PNS committee will be evaluating all of the proposals, and that the funding that they have to work with, including those additional 4 organizations that received funding last year, will be roughly $400,000, not 100,000. It will be 400,000. Again, that does not assume that the allocations provided last year to those 4 groups will continue as they were budgeted last year. It could, but it doesn't assume that that would be the case. Was that
And the
looking
reason
like that didn't make sense? So,
and the reason it's 400 rather than what we see, what we see on table 8 is 546.
let's bring that up if we could.
But that my understanding is we exclude from that the project safety net and the YCI that are not part of that competitive funding. Is that correct? That's how we get to roughly 400.
I need to see the slide too.
So how we get to the 400 is we take the total once the slide comes up.
Yeah, and
Would you
subtract
like to walk
100 for project safety net and subtract 50 for YCI, and that takes us to 496. Is that correct?
396.
396. I'm sorry.
Actually, well, so for what it's worth, It could be either, but my understanding was that it would include YCI as part of the evaluation. It excludes the community events CSD grants line item.
I thought a couple meetings ago, we got really clear that the YCS, YCI was meant to be included. They heard meetings where we reassured them of that.
It was the recommendation of the Finance Committee to proceed with the direct allocations to YCS as well as the other four organizations. When it went to the full council, the conclusion was to evaluate all the applications.
But
again, it doesn't presume they won't.
Yeah, but my memory is the same, that it wasn't that it was the recommendation of the committee. It was that staff came and said, we made a mistake on YCI and we intend to put it back in. That's my memory. Well, that was stated publicly, and I believe it's on the record of this committee, and therefore it wasn't part of our specific recommendation on what to do with these other ones. It was staff saying, oh yeah, it's back in the budget. And that's what.
Well, as a person who made the statement, I would agree that what I said was it was a lack of communication. We did not communicate to YCS that the fact that their agreement ended meant that they needed to apply through this nonprofit funding. And as such, it was listed here. I, quite frankly, made no recommendation or assumption that it would be a direct allocation as opposed to proceeding through the evaluation among the other nonprofit proposals.
Well, I will say that our understanding, and I don't know whether Keith has, it
was the unanimous recommendation of the Finance Committee that direct allocations be made.
Correct.
We're making a distinction here. We're making a distinction that YCI was not something that we took deliberate action on out of the committee because staff had said that, oh no, we made a mistake, and the staff voiced their intention to put it back in the budget, as opposed to all the others that were as the city manager described. That's the difference that we're having in memory. The three of us on the committee unanimously have a different memory. I believe that the record will clarify it of the committee meeting. If somebody wants to go back and listen to it, because it was public statements in the committee meeting by staff that was the basis for our understanding. And maybe we'll be proven wrong, but that, I think, is the memory of all three of us. And that's why we understood, as you said, on the other aspects. On the YCI, we had a different understanding.
Because Youth Community Service has had these funds since 2017 is my understanding from my conversations with them. It has always been 50K from the city and matched with 50K from the county going back to 2017. So it did feel like this one was a blip, that it had gotten misunderstood, that it seemed to be coming to, the end of its term and staff did not include it. And that was a shock to us and to the nonprofit that has been relying on this for many years now. And I felt that our initial Finance Committee conversation on this I think we spoke of it with alarm and concern, like what happened? This one is not meant to be in the bucket of things that are, sort of subjectively considered year over year.
Isn't that consistent with the third and fourth column here? That the fourth column is what we added in our direct allocations, but the third column is the 50,000 of the YCIs in that. Why is that not lumped?
What is changes versus allocations?
Yep.
No, yeah.
Yep.
Well, staff could clarify on that. My sense is that the changes reflect changes to the budget. The other column reflected a question of how it's then allocated to the specific organization.
Okay, so we as a committee have one recollection and we can still uh, make our budget recommendations to the council on that basis. And council as a whole can decide what they'll do. Okay. We've been at this a couple hours. So want to take a quick break? Oh,
Kylie just turned her camera on. Does she want to
Okay.
say something?
It's only gonna help if you guys had a question on the table, but you guys are good.
Okay.
Chair and committee, are we at a place on nonprofits to come to a recommendation? I'm just wondering, because it is 3:30. I think there were some head count discussions coming up as well. Or do we
I
want to
think
take a break
we'd
and
like
come
to
back?
take a break and then we'll come to make, I think we're ready to
Okay.
pull together everything.
Super.
Convening, we live again? All right. So as I understand it, now we want to look at the that original slide that would move things from the parking lot to recommendations. Is that correct?
Yes, we're ready to do that. And also, Sandra Blanche, HR Director, is also ready to present any FTE information.
Oh,
So
great.
I
Okay.
do know we are working towards 5 o'clock. So just whatever the
Yep.
pleasure of the committee is.
Hear from Sandra? Okay.
Afternoon, Chair
Great.
Berg and council members. Sandra Blanche, HR Director. Going to present the numbers we pulled. I think City Clerk, if you could put those up. Thank you. So I believe what we have here is what you were asking for, data from 2019 through current year. We categorize this by general fund on the right-hand side. So you'll see filled positions in comparison to the budget. And then on the left-hand side, it has the total budgeted FTEs for all funds altogether. So if you look at the general fund totals, the variance between 2019 through current date is only 19 positions. We did restore several positions after the pandemic.
What's the 19 you say?
The variance between
Oh, the
July
budget.
between July of 2019, if you look at the budgeted positions, to April 2025, that's only 19 positions.
In budgeted ones. So when
And
we have the budget and the general fund, yeah. So just as context, and as part of why this is really helpful and informative, is we budget certain numbers, then we have a vacancy level, and the difference between the budgeted vacancy level and the actual vacancy level contributes to the surplus. But then there's the question of, okay, how many people do we actually have working for the city versus what we put in the budget to fulfill the range of tasks that we have? And the tasks that we had in 2019 are not identical to what we have today. So we can't say that that's an apples to apples comparison, but it is a really important context that we almost never look at. And so we are, in the general fund, 39 more people on staff than we were in 2019. And in the, and so non-general fund is a little, not a great increase. I didn't do the math. So it's an important context when we are saying, gee, can we not fill certain authorized positions or even remove some of them from being budgeted? This gives some context.
We also do a lot of outsourcing. Has outsourcing changed over this period, or has that been fairly steady?
I don't recall any significant outsourcing changes during this period. Prior to that, I think the largest we had related to custodial services, landscape maintenance, so those would be the big ones in prior years. Subsequent or during this period, we did look at our print mail function and related functions, but ultimately there was not a conclusion to change our service models there.
Following the Great Recession, we really had a very deliberate consideration of what we could outsource, and we did quite a few positions and categories that we outsource, but state law has changed, and I don't remember the details, and it makes it more difficult for cities to outsource functions.
In the swimming pool, we converted over to Sheeper.
Yes, that was one that was prior to this period, I believe, our pool operations. I believe might have been prior. I believe during this period was our animal shelter going to Pets in Need. So that was a change.
So and that was about how many people?
Less than 10.
Okay, so that also is basically, you'd say that you could look at it two different ways, but those are additional people that would be added back to this count, because they were part of the 523, but they're not part of the 562 today, that less than 10.
So have we expanded scope, or is there a good reason? What are these extra people doing?
Well, I think we'd need to look at those individually. And, actually, I'm sorry. Well, the question is, have we expanded scope, or what accounts for the increase in
Difference in the head count?
Well,
this is
I mean, as an example, last year, we added a few positions for the JMZ because of the expansion.
Yeah.
Yeah, there are clearly areas that we expanded scope and others that it's not so clear what is the basis. And part of it is, and this goes to this question of our vacancies. We've worked to reduce vacancies. My memory is that we were told recently that in 2019, we were 12% vacancy, and now we're below 10%. And so we were sitting there, well, there's always this kind of roughly constant vacancy level. Well, in 2021 or so, it jumped up to 20 or 18%, as I recall, 2021 or 2022. So when we see, 483, 481, that we had budgeted for far more, and then only this last year is the difference between budgeted numbers and filled numbers starting to narrow to reflect our current vacancy levels. But we tend to look at the positions we have budgeted as opposed to the positions that we actually have as employed people performing functions.
So I think an interesting question here, Sandra, if you've got it, maybe don't have it now, but I think we might want it. How many of these unfilled positions have gone unfilled year over year? Because that's where we get a sense of, maybe this position is systemically deprioritized by the manager. There aren't the right people out there able to fill it. I mean, that's where we would want to look first, I think, for, should this thing even be in the budget anymore, right?
Yeah, and this is informative to us, I think, at a high level. Ultimately, we're relying on the city manager and his staff to look at how they can achieve these systemic cost reductions in the least detrimental way. And I think at a at a high level, this kind of suggests certain things, but it's only when they look at those individual functions, including if something's been vacant for years, was it really a necessary position? But there'll be a lot of examples, but I think it helps us in terms of what we set as goals. And I think it actually is something that staff would benefit from looking at more strategically on a department by department level.
So, Pat, when you raise this as a method of inquiry, I was trying to weigh for myself. So is it better for us to budget for the higher number of FTE to keep the budget at FTE, knowing we have vacancies, knowing that we're going to budget for some lower number of vacancies such that we then have cost savings. Is that the better way the way we've been doing it, is that the better way to go? Or is it better to have a more accurate budget of FTE in the first place?
Well, I think more accurate is valuable. You're never going to be able to precisely, there's a ebb and flow, and it can't be, we're only going to precisely do these. They have a lot of moving of pieces that they have to do. But I think more accurate is valuable. When we went through the Great Recession and had really severe financial impacts, we ended up kind of spreading our cost reductions over a couple of years, which were a combination of outsourcing and reducing the least critical positions. And we did it with virtually zero layoffs because we did it on a 2-year strategic plan as opposed to crisis management. And like I said previously, bunches on a council were saying, no, we're in a crisis. We need to have crisis management. And we got pushed back and said, no, we need to do this more deliberately. And so that staff can do it in a wiser way and with less negative consequences, because there is a lot of attrition that occurs. How do you align attrition with the vacancies? Because the spots that open up aren't necessarily the spots that the city manager might say are the least critical. So there's got to be some latitude that's allowed to, and a time frame to align those adjustments with managing vacancies and people being able to have lateral movements and a bunch of different management tools that I think we should set the higher level goal setting, and then we end up approving those org chart changes, whatever they may be, but they're recommended to us by the city manager. Great. This has been very helpful, and I'd like to recommend that the council also see this, and it'll help them as we go into these strategic decisions going forward, not just the coming weeks, but over the next year.
Do we have a head count of how many consultants we've hired? You kind of have.
What's a consultant? So if we've got contract employees that do functions similar to our own, and there's a variation, and this is where this whole consultant thing, we really need to get the breakdown differently from the master list that we had. So I think that's another, I mean, when we say outsourcing, that is an outsourcing function. When we have, say, plan inspectors that we outsource out of the development center, where they're doing the same task as our own people. And that gives us some flex if we couldn't hire or we have a surge in need, and we use these companies that do that. That's the one that comes most to mind, but I'm sure there are some others to a lesser degree that we use in that way. And then there's the true consulting functions. So I think we really need to distinguish contracted labor versus consulting.
Does Sandra have any estimates, or is that something that we don't have available?
Well, as it happens, we just issued a report that's going to the Policy and Services Committee next week on this topic more generally in terms of our service delivery methods. So we actually have provided a list of contracts that the council approved last calendar year as a way of seeing the range of services, and to the chair's point, it really is something of a continuum from what might be surge staffing to special expertise that we don't have in-house to, in the case of, as we've talked about, the regional water quality control plan, a whole team of both engineers, construction managers that are managing a larger program of capital improvements.
And you described it as surge staffing. Is that what you said?
Yes,
Yeah.
yes, to
Yeah,
handle
that's
the
good.
peaks and valleys,
Yep.
because obviously we
Yep.
wouldn't want to hire up for
Yep.
peaks and then have to lay
So
staff off.
that's probably the better term for that contracted services that I was referring to. Surge staffing. I think that is, it ends up being clearer to the public and everybody, and I think that would be a valuable category. Now, you said it's going to P&S,
Right.
but that's much more of a financial decision ultimately. I understand there's certain policy element.
I think it's really for the council as a whole, but we wanted to start the conversation there as a way to talk about the methods of service delivery, as opposed to, it's more an issue of how expectations are set with staff on our own role on scope of services and how the relationship and management of consultants is handled.
Well, I'd like to have that routed also to Finance Committee, and we can.
Well, we'd expect it will go to the council as a whole, given, again, that this, I know, is an issue of interest
Well,
for
but
the
that's
council.
not what I was saying. That we can have items that go to more than one committee. Yeah.
Well,
I
yeah,
can.
actually, well, I think it would make sense for the council as a whole. The only person who would be excluded in that route is the mayor. So rather than exclude the mayor, I think we'll bring it forward.
Yeah, but there's a depth of discussion that occurs in committee that is different from the council as a whole. That's the point. Okay. Yeah, I see it as having elements for both standing committees, but if I was to think of it, it's most of all related to our financial decisions and secondarily a policy decision, but that could be debated. So would we want to have that route through us for a more informal discussion before council, or are we comfortable with it just going to council?
Just looking at agendas and time, I think I'm comfortable with it moving to council as planned, and I'm confident that we can have a robust discussion on the dais about it.
Okay, now back to our attempt to wrap up. Is that right?
Yes.
And we had slide 15. Yeah. Keith?
One thing we didn't talk about is JED. Is that policy and services going to
Good
tackle
point.
that?
So we heard an illusion that there's funding in community services budget to be able
And
to.
CMO budget, Lawrence said both.
Well, so there's actually it was a couple of years ago, the council added ongoing funding to community services for youth mental health. And so we're expecting to tap into that as a primary source, but depending on the dollar amount, there may be additional funding required. And that's where I suggested, if needed, it would come out of the CMO contingency. Just to give you a quick status report, we are, so following the City School Liaison Committee's discussion and recommendation that the city pursue an agreement with the JED Foundation, my office is now taking the responsibility of setting up a meeting with the two members of the council, Councilmember Stone and Lou, along with staff, so Kristen and myself, with the JED Foundation to try to finalize the scope of work that will then come to the full council for approval. So that's where we're standing right now, and through that interaction, we'll get a better handle on the dollars required for that work.
And is there any PAUSD interest?
Well, as was discussed at the City School Committee, I think the primary role for CSD will be in some coordination, potentially activities such as issuing surveys to whether it's their staff or the PAUSD community, as well as providing data that would be used by the JED Foundation. So that's I think essentially the type of interaction we're expecting at this point.
Their role would include engaging with the community stakeholders that have been long involved in these areas.
Certainly starting with Project Safety Net that has had a primary role here. And then I think that question of what does that engagement look like is a part of the scope discussion that we need to have. I think we've talked about this as something of a gap analysis to see where there might be gaps among services provided by different organizations. So clearly that engagement will be important.
Okay, thanks.
Could I just add, having initiated the relationship between JED and the city, my conversations with them last summer gave me great confidence that they're quite adept at being an outsider who comes in, not with answers, but with methodologies for bringing the community together in ways that, have maybe been elusive. And they absolutely know that we've got Project Safety Net and we have the Herd Alliance and we have YCS and we have a school district and we have a city, and we have, others who have been hard at work at the issue of tackling youth mental health. So what impressed me is their ability to bring all the pieces together and, as an outsider, be more effective at transcending some of the kind of old wounds and internal politics and whatnot that are inherent when you're bringing different groups together that have been trying to work well together over time.
That sounds good because, part of my apprehension was that when Councilmember Stone, beginning of his mayor term, created his ad hoc committee without going through proper process, it lacked context. And it was kind of just context in this is and experience is extremely important. So I'm glad to hear that. Okay. Good there. It sounds like that's taken care of. And so are we looking at something akin to slide 17, an active version?
Yes. So similar to last year, Paul will walk us through what's in the yellow section, which is the parking lot, and ask for committee to formally move it to recommendation. You ready, Paul?
So this should look familiar. It was slide 15. Essentially, these are the items that we have for consideration. And so starting at the top, we have the uncertainty reserve. So this is the $4 million use in 2027. We have the sources for the paramedic transport fee revenue, the first responder fee revenue, and the rental and reservation fee revenue in CSD. So that's the source side. On the use side or the expense side, we have the increase of the fire single role model. We have the nonprofit work plan phase 1 funding. So this is the 111,000 to go from 235 to 346. We have the 50,000 for the CSD grants and community events program, 50,000 for the YCI funding. We have the $1 million for the Measure B funding. That would be a source of funding, so a savings. So the positive numbers down here are savings. We have deferring capital projects for 2.2 million. That would be a one-time item. And then we have the general fund expense savings with 2.7 million in 26 and 1 million ongoing.
Just for clarification, at the risk of opening a wound or beating a dead horse, this is the budget allocation. It's not making any assumption as to how the actual funding decision is made to specific groups. Does that make sense? Hopefully that makes
It does, but I think we're all noting that the YCI is not subsumed within the nonprofit work plan.
I think we already heard from Lauren that the understanding that the Measure B funding to the tune of 1 million is not something we want to go with. And she said, let's up the deferred capital projects from 2.2 to 3.2. So that feels like something we want to change. I don't know if we change it on the yellow or we move it over to the green and make that change.
The process is we're saying what we want in the green. Is that right? Right. Okay.
What does that mean, that we want 2.3?
No, do we want to just go from the top down?
Oh, sorry.
Go sequentially. I agree with you on that, but yeah. Okay. So that first one, restore the uncertainty reserve. we have this additional goal of reducing the use of the uncertainty reserve for FY 27 by 4 million. Right?
Yeah.
That makes sense? What we were talking about at the outset, that we were saying, what's the slide? Seven, okay, thank you. That
So effectively, we want the two reserves to add up to 60 million at the end of 2027.
Yes, and is that, how do I phrase this question? Is that a part of the adopted 26 budget? Or
no,
is that
it's guidance.
guidance? Correct. Thank you
Yeah.
for clarifying that, because I think we do not do a biennial budget here, and that's very important legislatively. I think we've heard the guidance today around the consternation at this reserve level, regardless of the buckets. We'll hear that as guidance, and as we look towards closing fiscal 25, we will know that we want to bring this reserve level up to
Well,
6.
and we want that to go to the council as a recommendation of the committee.
Okay,
Just
got it.
not part of FY 26 budgeting. It is a recommendation.
Got it. Good. So that'll be included as the write-up in the memo. And I want to make sure it's the combination of the uncertainty reserve and the BSR. So the 2 million plus 54, so that's currently 56, and we want to get that up to 60 million by the end of 27.
Correct. So, and so
That's
that
guidance.
even though that's not part of the 26 budget, it may shape your 26 budget if you know that you have this goal that you have to get to.
Yeah, and so that we'd be reducing those projected expenses in FY 27 from 318.4 to 314.4. That would be the 4 million.
Please repeat that, because I think that's very important and distinct from the additional 4 million in reserve.
I think they're one and the same, actually.
Yes,
Yeah.
but please repeat that
Yeah.
section, just make sure
Yeah.
I understand.
So
what's happening.
the basically the way that we would do what the Councilmember Rectal said of having our reserve, the combination of the BSR and the uncertainty reserve, go to 60 million is by reducing the FY 27 expenses by 4 million.
So if we say that differently and we look at slide 7, in essence, it would move us towards fiscal 27 of not utilizing the uncertainty reserve altogether. Because right now on slide 7 in fiscal 27, we're proposing to use 4 million, which was the prior direction, right?
Yeah.
Retain 6 million, use 4 in 27, leave 2 in fund balance. But today's conversation is we need to further.
Well, but let me say that the way you're framing it is premised on continuing to have a category of uncertainty reserve. So that's the other part is, do we want to also recommend that we just merge the two reserves? And as Councilmember Rectal framed it, is it would basically be our BSR would be 60 million for that year. And it's all the same outcome, but we would frame it as, he said those two reserves, and I would encourage us to say we just go to our budget stabilization reserve being 60 million projected for FY 27, and we no longer have a separate category of uncertainty reserve.
Yeah, effectively, yep.
It would be down to 2 million. What's the point?
60 feels high. I just wanted to check. If we're trying to get it to 18.5%, 60 would assume a general fund of 300, budget of 324 million. Is that how high we expect it to be in fiscal?
No, we'd be taking it down to 314, actually.
But a 60 million, if we're targeting at 18.5%.
Can you go back to slide
Well,
7, please?
He's
Paul's
targeting at
helped, it's on the
numerical
screen.
value rather than a percentage.
When we put in 60 million, the BSR becomes 18.9%. So it's above the 18.5% target.
So Keith is proposing it as a dollar numerical amount that then calculates to 18.9, as opposed to starting with a percentage.
To me, this is consistent with what we gave last time. We're changing our tune. It's just that last time we said you can use 4 on the uncertainty reserve, but there was some assumption that the BSR would be funded, and we didn't fund it. And so we're saying, no, you can use that 4, but you have to fund, because on slide 7, it says to get back to the standard amount, you'd want 4.5 million. So we're kind of saying, well, use the uncertainty reserve, but put it into the BSR. So it's not that we're changing our guidance, it's just that we're clarifying it.
I mean, we could approach it either way. We could approach it by setting the dollar goal or the percentage goal.
I'm fine with this. It's not as off as I thought it was.
Okay.
So let's just confirm up there in the table on the left, it says increase BSR to 60 million in 27. And I think after the fiscal 27, we should indicate that's the combination of UR and BSR.
Well, rather than combination, I would say that we recommend that we fold the USR into the BSR. We don't any longer have a $2 million USR.
And would that be effective in 26 budget? Or should we put that out there because it may confuse?
It's a clerical function to give better clarity. I'm good either way. I'd be inclined to do it sooner rather than later, but it's not really germane.
Yeah, same vote. Is that?
Yeah.
Whatever, Lauren, whatever you think.
Yeah, I
makes more sense for
would.
you.
Let's go ahead if colleagues are good that we would combine the two reserves for FY 26.
I worry a little bit about coming back to council and the numbers in the reserve changes so much between proposed and adopted.
And that's fine. Like I
Council
say,
may get confused because that percentage just jumped because of the change in accounting.
Then we'll make it effective for FY 27 that we have a single reserve.
Yeah, I think that continuity of discussion is really important to me.
Good enough. Okay.
I mean, but in my mind also, though, we are saying in 2028, we'd be willing to use 2 million of that reserve to help the budget. And usually BSR is not from a year to year. It's more of a big picture stabilization. So in the past,
ebbs and flows, it's called a budget stabilization reserve.
Okay.
So we didn't really dip into it in COVID, interestingly. Yeah. I don't know how much, but not very much.
I said I didn't mind either way, but I just, in thinking about it, I think about future councils and committees looking back on this, like, why did they say 60 million was important instead of hitting the 18.5 target? We're now at an amount that is 18.9, which is higher than it needs to be. Is that important to you? Why is the 60 million?
6 million or 60 total.
60 total, as opposed to, let's get it back to the percentage that has historically been our target.
For 2027, again, this is my thinking of it, is that 4 million from the uncertainty reserve would go towards the budget to help prop up the budget. And the following year, we'd have propped up by only 2 million. So we're weaning ourselves off the uncertainty reserve. But in addition to that, this current 26, we're not funding the BSR at all. going in 27, I want to see some funding into the BSR. So the problem is that we have we're shuffling money between two things.
Well, and I will say the genesis of that, how we got to that dollar amount is we have a projected $8 million deficit for FY 27, and it was to cut it in half, and that was 4 million. And that's how we got to that numerical amount. I'm good either way. If we think that the council is going to be more comfortable with combining our two reserves and saying we're getting back to our target level of the reserve, and that's a little less than the 4 million.
I think it's easier to understand.
Yeah.
I think it's
I think that's-
adhering to a policy that we've had, getting back to that discipline of 18 and a half.
Yeah, and you know, we're those cost savings are work ahead of us, and so I'm not wedded to a precise dollar amount.
So let staff take an opportunity to revise that. It would be increased BSR to achieve 18.5% in fiscal 27
You okay with that, Keith?
and dissolving the UR effective 27.
That reduces the reserves by $1 million, but
Yeah, but ties it back to the policy and kind of gets us back to,
By the time we get close to that budget, we're going to have a lot better understanding of, are we in good shape, bad
we're not,
shape?
it doesn't change anything we do in the next 9 months. So,
Yeah. Okay. Okay. Next one, paramedic transport fee. Let's go to the easy ones. We all agree, move that over? Okay. First responder fee revenue, move it over. And
you'll recall, this is the one where our consultant has said we're going to get 400,000 out of it, but we're only putting 100,000 in. We're taking 25%, being extremely conservative.
okay, we're good with first responder?
Yep.
Good. Heads nodding, yes. Rental and reservation, yes, yes. Okay,
Yep.
now we're moving. Fire single roll, yes, right? Yeah,
Yep.
okay. Nonprofit work plan, adding the 110, yes?
Yeah, but I mean, I want a bigger plate. I'm not sure if I can afford a bigger plate, so we just leave it. Can you afford? Yes. All right, but do you think we can afford a bigger plate?
Well,
When you look at how small these dollars are compared to the big knobs.
Yeah, and I would say though that all these other applicants for that, they weren't counting on it. There are only 4 that were counting on it. No, this came out of the blue. And then for all the rest of them, they came out of the blue. So that goes to, it's a whole different context, and it's part of the problem, is that we had 4 who were counting on renewal of the budget, and then it ended up being a big competition, and so we said, well, let's make the pot bigger, so that hopefully those other ones can get something, and PNS will still choose to fund those 4. But there wasn't, at the start of this, some concept that for all those others, they were surprised. They didn't know what this is all about.
Maybe we just leave it as is.
Leave it as is.
And then in 27, we can hope for a bigger plate.
Yeah. Okay, we'll move that. The CSD Community Events Grant. So I am confused whether isn't that going back though to still being part of the PNS process?
Well, the program as proposed by staff is separate from the nonprofit grants. It's it has been described as a first come, first serve, up to $5,000 for events that are larger than the Know Your Neighbors grants. Yeah.
Would it just be staff administered and doesn't have to go to PNS? So it goes in the budget, but it doesn't have to, it just goes in the budget.
Correct. I think staff would want to make sure council is aligned with the administrative process we use, but it would not need any big process behind it. Kristen, any correction there?
No correction. It would be managed similar to the Know Your Neighbors grant, first come, first serve, and there would be just a review process of applications.
And the only question on the first come, first serve, that means we could get all done the first quarter of the year and really great events later in the year. So should staff be looking at actually staggering it over the course of the year versus, and then you could still in a quarter be first come, first serve or whatever, second half of the year, first come, first serve. But, and none of us know what kind of applications we're going to get, but I am worried that it could jam up everything chronologically, or just those that knew about their event and knew about this, they got in early, and others that were meritorious just either didn't know or were later in the year.
Sure. That's, yeah, an interesting comment. And I think we should look into that. We do that with our Emerging Needs Fund. It's a quarterly application process so that we don't spend everything right at the beginning of the year. So we can certainly look into that.
Okay,
Thank
we
you.
can just leave that as guidance. All right, so then that moves over CSD grants. And then the YCI, this is our recommendation. It's going in the budget, right? Agreed?
Yep.
Okay. And I think we'll be able to take one vote at the end because we seem to all be in consensus. If we're in disagreement, we'll take a separate vote.
So
So
Chair,
we're not,
yeah, so I think the next line, if I may, we're striking Measure B, because I think we heard that feedback this afternoon, that 1 million would get folded into the next row, which is the deferred capital
got it.
as a placeholder.
Okay.
So Paul's going to type it up on the left. Just want to check in with Finance Committee, the way it's presented.
Okay. Yep. I'm just looking at under that deferred capital, there's also 1 million in 27. I'm trying to remember.
No, because if we're striking Measure B for both years, then we have to move both those values down. So what used to be 0 for the capital projects now has become 1 million in 2027.
Okay.
And that's working towards that 4 million, 2 million split of 2 million being ongoing. Right now, we just have that 1 million in the CIP placeholder. If we can find deferred capital projects for 3 years, but right now that's what that represents.
Okay. And then general fund savings, and this would exclude the FY25 ending balance.
Right. So when Paul copies it over, we'll strike
Yep.
that text.
Got it?
Ready. When you're ready, can we go back up to the first line? Because I think we've got to plug in some dollars there.
Yes. How many dollars would it be?
It's 18.5% up to 317.8 million is 58.7 million. We were trying to initially
Well, how'd you get to 317?
projected budget for fiscal 27.
Well, it was 318.4.
No, it says 317.8 right there at the bottom of the chart. Look.
I don't know what you're looking.
So up in that spreadsheet on the lower corner where
Looking
it's
at
yellow.
slide 7.
Yeah, she's looking at this. I agree with you that they're different. Now move this. There.
So can you explain that difference between slide 7 that said the projected 318.4, but then when we reduce the budget,
Yes. So
and so we subtract from whether it's subtracting from the 317.8 or the 318.4, we subtract it down to the level to get to 18.5. I don't know how you go back and forth.
All right. Right. Who knows? You guys, we don't.
So so we will, how about that, we'll put in the percentage and we will count it by the time it gets to the council, they'll have put the dollar amount in.
But I think part of the discussion was to move the direction towards the percentage.
Yes.
Yes.
And
So
so
it's the 18.5%.
Whatever it turns out to be
But-
right. budgeted.
but we're going to have a budgeted amount to get back up to that BSR level. It will have reduced the projected expenses by 3 million or so.
Right.
So
Just
then we want to put we want our colleagues to understand that it includes a specified reduction in the projected expenses for FY27 in order to get to that point.
would it be suffice if we just indicate that it would be increased BSR to 18.5% of projected fiscal 27 budget? Would that be suffice? Because I think, as you mentioned, that projected 27 number does continue to change.
Yeah.
It's kind of circular too, because if you make cuts, then the
Yes,
BSR goes.
But we have projected numbers, and I think we want our colleagues to understand that we had a projected budget of, and I'm still not clear whether it's 317.8 or 318.4.
So it's 317.8 because you are adding costs for fire for the other nonprofit items. So that's an addition of about 1.4 million. And then we have the ongoing 2 million of savings that we're going to have reductions for you. So you're actually reducing your expenses by 600,000.
So that's the right number. The older 318.4 I should ignore. Got it.
Let me say this, let's not lose. We've got 4 million and 2 million in the uncertainty reserve that we did not use in our fiscal 26 that have to show up in here.
Your mic is off.
Sorry.
Thank you.
You know, no one else has had quite that tut-tut. I got my hand slapped. Your mic is off. Yeah, right. All right. Let's not lose. We had this bucket of money, right? We were going to spend all of the balance of the uncertainty reserve on fiscal 26. Commissioner
All but two.
I'm just saying originally, and then Councilmember Rectal was like, wait a minute, we need to spread this. Let's only spend 6 this year. And we're going to split the remaining 6 into 4 for 27 and 2 for 28. So that 4 for 27 might turn out to be too much because it gets us over the 18.5 in the BSR, right? But it is something. So you're putting in 1.3.
So if you have 6 million that you've saved in 2026 and you move that into 27, you take 4.7 of that to move into the BSR to get to the 58.7, you have 1.3 million left.
1.3 million left in what?
So it would currently be in the uncertainty reserve. You could put it into the
I see.
BSR, or you could use it to fund expenses.
Got it. Okay.
I think
But
I understand.
that's all kosher, yeah.
All right.
So we are subsidizing the budget still, but only 1.3 as opposed to before we had more.
Okay, and down where we say potential funds remaining net, we say remaining. Is that really the way to describe this? Isn't this really saying what our reductions are in the net from the budget?
Where are you, please?
Yeah, I know that's me. You know what that means, but the audience of our colleagues, I'm not sure that that's simple to them. Isn't it in essence that, I mean, these were the cost, the net changes to the proposed budget of additional revenue and reduction in expenses.
Yeah, so perhaps what we could do in the table on the left, since these are the recommendations, it could read net cost / sources and drop the prior 3 words.
Mm-hmm.
That's fine.
Okay, good. Just want to help make sure our colleagues understand what we've all been going through. All right. Are we there and ready to vote on this? Is there anything else that we need to cover?
Can I ask, just seeing council contingency at the bottom, does anyone know how much is left in council contingency in 25 right now? And it doesn't roll, right?
No, it doesn't.
So-
And it hasn't been getting spent much
Right.
this year.
I
Just want-
recall this question came up on, I think, on day one of our workshop, and I think the expenditure was something small, like 10,000 for the event for Joseph's Median event. Mhm.
So I just wonder if it doesn't roll and as we're nearing the end of our fiscal year and we're looking at all these nonprofits that need funding, I realize it's not a long-term solution, but I wonder if we might recommend that the balance of the council contingency funds for fiscal 25 be put toward.
How about that we wait until we see what PNS does?
Yes. Okay.
This has been in the back of my mind. I just didn't want to say it, but okay. I don't want to take the heat off.
The ace up your sleeve.
Yeah, okay.
For the poker with the
Yeah.
Unless they're watching this meeting.
Yeah. Okay, all good? All right, all in favor? Aye, that passes unanimously.
Chair and committee, I also want to confirm that also our understanding is that the details of these placeholder then will come back to committee on August 19th. So this will move forward and advance the adoption of the budget with the placeholder, which reduces appropriations, but will allow staff time to develop that and then bring it back to committee.
Okay.
Thank you.
Thank you. Good.
Could we just say, I know the chair will say this, but if he doesn't, I will say, thank you so much for your tremendous work.
It's been,
It's been a lot and you've been extraordinary. First full year.
Yes, thank you. Thank you. And thank you for everybody who works behind the scene. I have the honor of being here to represent the body of work, but thank you so much.
okay, on that note, we're adjourned.